Banks do not just run on money, they also run on numbers. And the most important numbers are their KPIs or key performance indicators. Hello, everybody. Welcome back to your favorite FP&A channel. My name is Asif Masani, the co founder at FP&A Professionals Institute. And today we are diving into the top 10 banking KPIs that every FP&A professional should know. These aren't just theoretical concepts, they are metrics that tell you if the bank is profitable, efficient, and sustainable. By the end of this video, you will have a clear understanding of the 10 most important banking KPIs that can sharpen your analysis and help you tell better stories with numbers. Let us start with the big one, net interest margin, also known as NIM. Think of this as the core profit engine of the bank. It measures the difference between the interest income banks earn from loans and the interest it pays out on deposits. If the net interest margin is high, that means the bank is effectively squeezing more profit from its lending activities or is able to source the deposits at a lower rate. However, if the net interest margin is shrinking, that could mean either the cost of funds are rising or something like regulation or competition is pushing the lending rates down. As an FP&A professional, watching the net interest margin or the NIM trend helps you anticipate profitability pressure on the bank long before it shows up on the bottom line. But profitability isn't just about earning more, it is also about spending less. And that brings us to our next KPI. So, on number two, we have the cost to income ratio or the efficiency ratio. This KPI tells us how much the bank spends to generate a dollar of income. If the efficiency ratio is low, say under 50%, it means the bank is operating efficiently. But if the efficiency ratio is creeping higher, it could signal bloated costs or falling revenues. However, it could also happen that sometimes banks intentionally let this ratio rise when they are either investing in technology or digital platforms. So, as an FP&A professional, it is your job to separate the short term cost hikes from the long term efficiency gains. Of course, no matter how efficient the bank is, if the customers stop paying their loans, the profitability will take a hit. And that's why the next KPI is so critical. Next up on the list is NPL or NPA ratio. Some banks call it the non performing loan ratio, NPL, and some call it the non performing asset ratio, NPA ratio. Now, banks live and die by their loan quality, and the NPL tells us exactly that. NPL measures what percentage of banks' loan are in default or close to default. If this number is climbing, it is a red flag that the banks may need to set aside more provisions which can cut into its future profits. But it's not just a backward looking metric. Rising NPLs can also be an early warning sign of trouble in the wider economy. As an FP&A professional, you're not just reporting numbers, you're also explaining the story it tells about the credit quality. And if loans are the lifeblood of banks, we should also look at how those loans stack up against deposits. That brings us to our number four banking KPI, the loan to deposit ratio. This shows how much of the customer deposits are being to used to issue loans. A healthy loan to deposit ratio sits between somewhere 70 to 90%. Too high and the bank may be overextended, risking liquidity. Too low, and that could mean the bank is not making the most of its deposit base. What I love about this KPI is how it blends strategy and risk and shows whether the bank is aggressively chasing growth or playing it safe. Efficiency isn't just about lending decisions, it is also about how effectively a bank uses all of its assets. That's where our next KPI comes in. On number five is return on assets or ROA. ROA tells us how well the bank is using all of its assets to generate profit. In banking, even small changes in ROA percentages matter, and ROA around 1.5 to 1.8% is considered strong because banks usually operate with massive asset bases. For FP&A, the key is to track ROA over time and then benchmark it against peers. A drop in ROA could mean falling margins, rising costs, or inefficient use of banks' resources. But investors don't just care about assets, they also want to know what is happening to their equity. That is where return on equity or ROE steps in. On number six of the list is return on equity. ROE is how much profit is being generated for every dollar of shareholder equity. ROE matters because it shows whether investors are getting value for their capital or not. But here is the nuance. Sometimes high ROE can be fueled by excessive leverage, which can add to massive risk. That is why FP&A professionals often analyze ROE alongside capital adequacy ratios or the CAR ratio to ensure that the returns are sustainable and not just used up by debt. Related to ROE, another measure is return on tangible common equity or ROTCE. Now, ROTCE is just like ROE, but it ignores goodwill and other intangible assets so that you can see how much profit the bank makes on its real tangible capital. Speaking of risk, let us look at how regulators ensure banks stay safe through capital buffers. Now, on number 7, that brings us perfectly to the capital adequacy ratio or CAR. This is one of those metrics regulators watch like a hawk. CAR measures a bank's capital against its risk weighted assets. Why does this matter? Because this tells you if the bank has enough cushion shocks like loan defaults or economic downturns. Most regulators under Basel rules expect this to stay about 10 to 12%. And as an FP&A analyst, keeping an eye on the CAR helps you assess not just profitability but also banks' resilience. But it is not just about having enough capital. It is also about making sure the funding sources are stable over the long run. That is where the next banking KPI shines. On number 8, we have something called as net stable funding ratio or NSFR. While CAR is about capital strength, the net stable funding ratio is about long term liquidity. It compares banks' stable funding like deposits and long term debt against the funding it needs for its assets over a 1 year horizon. Number here is 100%. It suggests that the bank may not have enough stable funding to support its assets. It's a relatively new KPI in the regulatory world, but it is critical for FP&A teams when they are stress testing liquidity scenarios for a bank. Now, even with the stable funding, banks can't ignore credit risk, which brings us to another important safety net, banking KPI number 9, provision coverage ratio or PCR. Imagine this as a safety net. It shows how much of the bank's bad loans are already covered by provisions. A high PCR or coverage ratio means that the bank has set aside enough to absorb potential losses. A low PCR suggests that the bank may be underestimating the credit risk. For FP&A, this KPI is vital in forecasting future profitability because higher provisions can weigh heavily on earnings. And finally, while most of the KPIs focus on lending and deposits, there is another side to the story, income that doesn't depend on interest at all. That's why on number 10, we have something called as the fee income ratio. Again, it has different names. Some banks call it non interest income or non interest revenue as a percentage of interest revenues or the non interest income ratio. It is the same. This shows how much of the bank's revenues come from non interest sources like credit card fees, wealth management fees, insurance, and trading commissions. Why does this matter? Because when interest margins are under pressure, fee income or non interest revenue provides stability. Banks with strong non interest revenue or fee income streams tend to weather interest rate cycles far much better. So, as an FP&A professional, this KPI helps you understand how resilient the bank is on lending versus other diversified income sources. So, there you have it, the top 10 banking KPIs for FP&A professionals from net interest margin to non interest income ratio. All these metrics cover the full picture of a bank: profitability, efficiency, risk, capital strength, and diversification. Remember that each KPI tells a part of the story, but together they give you the full narrative of a bank's financial health. In the last video, we covered the top 10 banking KPIs. Today, we will shift our focus to the credit card business. And based on my 2 years of experience of working in credit card FP&A team, I am going to walk you through the 10 most important KPIs that show how credit card business makes money and manages risk. But before we get into the credit card KPIs, let us first understand the 5 important terms related to the credit card business so that we both are on the same page. First term is revolver. A revolver is that person who carries a balance on the credit card and pays interest every month to the bank. The bank usually loves this type of customer. Second type of customer is the transactor. A transactor is a person which is opposite of the revolver. They usually pay their balance in full before time and hence they are not charged any interest, but they still generate fees and interchange revenue for the bank. The third term is interchange. Interchange is the small fee merchants pay every time someone swipes a credit card. They are very small per swipe, but they become massive in aggregate. The fourth term is called delinquency. Delinquency just means late payments. Most likely it is bucketed in 30, 60, and 90 days overdue. And finally, the fifth term is charge off. Charge off is when the bank finally gives up and writes off a credit card loan as uncollectible. Great. Now that we are all on the same page with the basics out of the way, let us zoom out for a moment. And before we dive into the credit card KPIs, it will be very helpful for us to understand how the credit card business actually works. When you use a credit card, the bank can make money in three different ways. First is the interchange fees. So every time you swipe, the merchant pays a small fee and a piece of that goes to the bank. Second is the interest. If you don't pay your balance in full, then the bank earns interest on what you carry forward. And finally, the third is the fees. These are things like annual fees, late payment fees, or cash advance charges that add up. That's the business model of a credit card in a nutshell. There are millions of swipes, balances carried forward, and fees collected, all flowing into the bank's revenue. Now that you know how credit card business makes money, the credit card KPIs will make more sense to you because most of these KPIs tell you how well one of these money streams is actually working. So let's dive into the first one. First up is net interest margin or NIM. NIM is just the profit spread on the credit card lending. When customers carry balances, the bank charges interest on them. But the bank also has to pay for that money it lends through deposits or borrowings. So NIM is the difference between what the bank earns on card balances and what it costs to fund them. If the NIM shrinks, profitability drops fast. It could be because of more people are paying in full or funding costs are rising. But interest isn't the whole revenue story. What if it fails, but the overall revenue still looks fine? That's where our next KPI comes in. At number two is average revenue per card or ARPC. Average revenue per card takes all the credit card revenues like interest, fees, and interchange and divides it by the number of active cards. For example, if you're making $100 million on 1 million credit cards, that's simply $1,000 per card. It is simple yet powerful. If NIM is down but average revenue per card is steady, you know that fees and interchange revenues are making up the gap. Now, to really explain those shifts in revenue, you have got to zoom into the customer behavior. That is where our third KPI comes in, the revolver and the transactor mix. This is one of the most important levers. Revolvers fuel interest income, but they also add credit risk. Transactors, on the other hand, fuel fees and interchange income, but lowers interest revenues. If revolvers say drop from 60% to 45%, that shift alone can explain the falling profitability. Your job in FP&A is to connect the dots. Did a new marketing campaign bring in more transactors or revolvers? Was it a zero interest promotion or was it a consumer caution in the economy? Alright, so we have covered the big three card KPIs: net interest margin, average revenue per card, and the revolver transactor mix. But no profitability story is complete without looking at the risk. That's where we come to the credit card KPI number 4, delinquency rate. Accounts that are 30, 60, or 90 days late don't sink profitability immediately, but they are almost always a sign of what is coming next. So you break this down by vintage. Are new customers missing the payments or is it the seasoned ones? That tells you if it's weak underwriting or a broader economic crisis. When those delinquency warning lights flash for too long, they eventually turn into actual losses. That brings us to our credit card KPI number 5, net charge off rate. Charge offs are when the bank finally gives up and writes off the credit card balance. It is the hard hit to the bottom line. Delinquencies usually lead charge offs by a few months. So, when you spot rising delinquencies, you can warn the leadership about the storm that is on the way. Okay, so let us shift gears a bit. Risk is one piece, but what about the revenue growth? Are the customers that you're adding even worth it? Let's talk about our credit card KPI number 6, customer acquisition cost, also known as CAC. Customer acquisition cost is everything that you spend to bring in a new credit card holder. It could be marketing, sign up bonuses, or any other gifts that you give. Here is a trap. Low CAC looks great, but if it is attracting low value customers, then you are just filling up the portfolio with dead weight. That is why you never look at CAC alone. You pair it with our next KPI, which is KPI number 7, customer lifetime value, also known as CLTV. Customer lifetime value is the total profit you earn from a credit card customer across their lifetime. The golden rule here is CLTV should be at least 3 times of anything less, and you could be burning money. As an FP&A analyst, breaking down CLTV down by acquisition channel shows you where your best customers are coming from and where you are overspending. All right, so we have tackled the acquisition part. But once customers are in, how much does it cost to keep them active? That's where our KPI number 8 comes in. Cost per active card, also known as CPAC. Cost per active card includes everything: your customer service costs, fraud prevention, rewards, IT systems. The strong revenues doesn't mean much if your cost per active card keeps higher than the average revenue per card. So if you're earning $300 per card but spending $320 to maintain it, you are actually losing money per account. Which brings us to the simplest but the most powerful metric, KPI number 9, profit per active credit card. This is just net profit per active card. It is the quickest way to compare different credit card product lines. If one credit card generates $500 per card and the another one $100 per card, you know where to focus for growth. And speaking of growth, there is one last KPI you can't afford to ignore. That is KPI number 10, new accounts growth versus attrition. This tracks whether your portfolio is actually growing or shrinking. This is new credit card signups minus the closures. Big acquisition numbers may look great, but if attrition cancels most of them out, you are running in the same place. This KPI keeps you honest. It is about the net growth and not just new customer additions. So let's wrap it up. While looking at the credit card business, when profitability drops, you start with the big 3 KPIs: net interest margin, average revenue per card, and the revolver transactor mix. They'll give you the fastest diagnosis. Then you layer in delinquencies and charge offs to capture risk. Next, add CAC and CLTV to test acquisition quality. Next, you look at cost per active card and profit per card for efficiency, and finish with growth versus attrition to ensure sustainability. Put them together, and you've got a full narrative: what changed, why it happened, and what leadership should do next. If this video has helped you, hit the like and subscribe button and share it with someone in your network who is working in FP&A. Also, check out the links to free resources, including books, courses, and cheat sheets. All the links are in the description below. In the next video, we'll talk about the top 10 FMCG industry KPIs. What if I told you that many FMCG companies fail not because of bad product, but because they track the wrong KPIs? FMCG, or the fast moving consumer goods industry, is one of the toughest industries in the world because it has razor thin margins, intense competition, and constantly shifting consumer demand. So the difference between a winning company and a struggling one often comes down to the KPIs that they track. In this video, I'll be sharing the top 10 FMCG KPIs that every FP&A professional must know. We will cover what they mean in very simple terms, why they matter for the FMCG business, and how they are shaping up the analyst work in FP&A teams. So by the end of this video, you will have a complete toolkit to transform your role from a number cruncher to a strategic business partner. So let's dive in. The first KPI that we will talk about is the gross margin. Margins make or break the business in FMCG. A 1% slip across millions of units sold can wipe out the entire profits. In very simple words, The gross margin is the percentage of sales revenues left after deducting the cost of goods sold. For example, if you are selling a chocolate bar for $1 and it costs you 70 cents to make it, then your gross margin is 30%. Consistently tracking gross margin helps you catch rising raw material or packaging costs. In terms of FP&A teams, the gross margin guides pricing, budgeting, and category profitability analysis. A healthy gross margin funds innovation and trade spend. Now you've talked about gross margins, but margins tell you what's left after the cost, but the revenue itself is equally critical. In the next KPI, let's talk about sales. Let's talk about FMC KPI number two, sales and volume growth. In FMCG, the shelf space in the retail stores are rented with performance. Your net sales growth shows if your brand is gaining or losing traction. So the revenue growth in simple terms is the increase in sales revenue after the discounts, returns and allowances. Let's take an example. If last year you sold $10 million in revenues and this year it is going to be $12 million, your net sales growth is 20%. This is the number retailers and management watch first. In terms of FP&A, for us as FP&A teams, the revenue growth is foundational for all forecasts and the annual operating plans we do. It sets the growth assumptions for scenario modeling and sensitivity analysis. But sales or revenue growth without understanding the volume impact is incomplete. So, along with the revenue growth, you also need to look at the volume changes. Now, promotions can inflate the sales in dollars, but the unit volume shows the true consumer demand. In simple terms, the volume growth is the increase or decrease in the actual number of units sold. For example, a juice brand may grow 10% in revenue, but if the units sold only grew by 2%, most of the growth came from the price rise. That insight changes the strategy. And speaking of pricing, let us look at the next KPI. Next is FMCG KPI number 3, price realization, also known as the pricing mix. FMCG players rely heavily on smart pricing and premium product mixes. Now, price realization shows how much of the sales growth is due to higher prices rather than more volume. In very simple terms, it is the impact of price changes and the product mix on sales. For example, if the volume stays flat but the revenue climbs, then the price realization is positive. For instance, if you can move the consumers from a $1 chocolate pack to a $1.2 chocolate pack, you are improving the price realization. Now, price is one side of the coin and the other side is the cost. That's where our next KPI comes in. FMCG KPI number 4, which is trade spend as a percentage of sales, also known as trade spend return on investment. FMCG companies spend heavily on promotions, discounts, and retailer incentives. This spend can easily eat up to 20 to 30% of revenues. So the trade spend is the return on investment from promotional and marketing trade activities. In simple words, it is the portion of the sales you give back in promotions. For example, if the sales are $10 million and the trade spend is $2 million, then the trade spend percentage is 20%. A small improvement in efficiency here can unlock huge profit gains. In terms of FP&A, this is critical for marketing budget allocation and promotional planning decisions. FP&A team also ensures that the trade budgets are allocated to channels and promos that deliver profitable volume growth. But once your product reaches the shelves, the real battle begins. Are consumers actually picking up your products? That's where our next KPI comes in. That brings us to our KPI number 5, which is market share. Remember, FMCG success isn't just about growing sales, it is also about growing faster than your competitors. In very simple terms, the market share is your brand's sales as a percentage of the total category sales. Let's take an example here. If the total toothpaste market is $1 billion in your country and your toothpaste brand is selling $100 million, then your share is 10%. Even sometimes a 0.2% gain can be celebrated here in the boardrooms. For FP&A, it is critical for competitor benchmarking and understanding the strategic growth bets. Now that we've talked about the market share, let us zoom into the supply chain side because sales don't matter if the shelves are empty. Next on the list is FMCG KPI number 6, on shelf availability, also known as OSA. Now, nothing kills sales faster than an empty shelf. OSA measures if your product is available when and where the consumer wants it. In very simple terms, it is the percentage of time your product is actually in stock at the retailer's shelves. For example, if your cereal is available in 90 out of the 100 store visits, the OSA turns out to be 90%. Low on shelf availability means lost sales and frustrated consumers. But even if the products are on the shelf, inventory mismanagement can destroy your working capital. Let's talk about the next KPI, which is inventory turnover. FMCG companies handle massive supply chains. Slow inventory can tie up cash. On the other hand, too little could lead to stockouts. Inventory turnover, in simple words, is how many times you sell and replace your inventory in a year. Let's take an example. If the average inventory is $5 million and the annual cost of goods sold is $25 million, in that case, the inventory turnover is five times in a year. A higher inventory turnover usually means a healthier supply chain. In terms of FMCG, many products have a limited shelf life and the products expire. High turnover means that the shelves stay fresh and the working capital is not locked. Now that you've talked about inventory efficiency protects cash. But what about profitability after all the expenses? That's where our next KPI comes in, the EBITDA margin. So let's talk about FMCG KPI number 8, the EBITDA margin. While gross margin shows product profitability, the EBITDA margin shows the whole business operating efficiency. In very simple terms, it is the earnings before interest, tax, depreciation, and amortization divided by the total sales. For example, if the EBITDA is $2 million on a $20 million sales, the EBITDA margin is 10%. In terms of FP&A, this is used for benchmarking against peers and identifying cost optimization levers. Next, let us talk about the FMCG KPI number 9, which is days sales outstanding, also known as DSO. In simple terms, it is the average time required to collect the receivables. Let's take an example. For example, you have $50,000 in accounts receivable and you have made $150,000 in credit sales over a period of 1 month, then your days sales outstanding is 10 days. For FP&A, it helps drive credit risk analysis and cash flow forecasting. Also, it helps deciding financing buffers. Now that we have talked about DSO and collections, which helps you keep liquid, but the brand strength can help you keep profitable. That is where our next KPI comes in. Next, let us talk about the FMCD KPI number 10, which is Brand Equity Index. It is defined as the composite score of awareness, loyalty, quality perception, and the associations. For example, a brand equity scoring of 85 on 100 in awareness and loyalty justifies a additional pricing of 5 to 10% higher than the competitors. Strong brands demand premium pricing, reduces reliance on trade spends, and can resist commoditization. In terms of FP&A, it helps link marketing spend to the financial value and support the long-term valuation and the pricing strategies. Now that we have talked about the brand equity index, which drives demand, and have covered the top 10 FMCG KPIs that I wanted to do in this video, but there's one additional bonus KPI which I could not keep out of the video. That is FMCG KPI number 11, which is called the perfect order rate. Perfect order rate is the percentage of orders delivered complete, on time, damage free, and with the correct paperwork. For example, if there are 980 perfect orders on a total 1000 orders, that's a rate of 98%. A 2% slip here at the FMCG scale can mean millions of dollars in lost sales. And remember, retailers can cut shelf space for unreliable suppliers, while high scores here can protect your relationships. For FP&A, it reduces penalties, avoids lost sales, and signals supply chain efficiency. FP&A uses it in capex and logistics planning. And with that, you have got the complete FMCG KPI playbook. Let's do a quick recap. The gross margin and the EBITDA margin shows profitability. The inventory turnover ratio and the DSO helps keep the cash flowing. The revenue growth, market share, and the brand equity index helps track competitiveness. And finally, the trade spend ROI and the perfect order rate ensures that the execution pays off. For FP&A professionals, all of these KPIs aren't just reports. They are levers to guide strategy, allocate resources, and protect profitability in one of the toughest industries in the world. Two hotels with the same occupancy can end up with very different profits. Why? Because one hotel can track the right KPIs and the other can only look at the surface level numbers. Welcome back to the channel. In this video, I'll share the top 10 KPIs that every FP&A professional in the hospitality industry must master. These KPIs can help you connect the guest demand, operations, and profitability into one clear financial story. By the end of this video, you will know how to transform data into strategies that can help you keep your organization ahead of the competition. Hospitality KPI number one is the occupancy rate. This is the percentage of available rooms occupied over a period of time. It is the core demand indicator. Remember, empty rooms are perishable inventory. You can't sell yesterday's room today. For example, a 100-room hotel with 75 rooms sold is 75% occupancy. If fixed costs stay the same, rising occupancy from 70% to 80% could add another $30,000 to the monthly revenue. In terms of FP&A, the occupancy feeds directly into the revenue forecast, staffing schedules, and housekeeping budgets. FP&A uses it to project the labor needs and the energy costs. But the occupancy only shows how full the hotel is. To know if you are maximizing the revenue per guest, you need the next KPI. That brings us to hospitality KPI number two, average daily rate, or also known as the ADR. It is the average room revenue per occupied room. It shows the pricing power. A luxury hotel with fewer guests but higher ADR can outperform a budget hotel. For example, a $15,000 in room revenue divided by 100 rooms is 150,000 ADR. Raising ADR by just $5 across the year means thousands of dollars of incremental revenue. In terms of FP&A, ADR shapes revenue planning, competitive benchmarking, and pricing strategies. FP&A models ADR scenarios to test effects of price hikes or discounts. When you combine occupancy and ADR, you get the single most important top line metric in the hospitality industry, which is the KPI number three, which is revenue per available room, also known as RevPAR. It is defined as total room revenue divided by available rooms or the occupancy rate multiplied by the average daily rate. In terms of hospitality, it balances occupancy and price, perfect for comparing performance across hotels. For FP&A teams, RevPAR is often the first metric investors, asset managers, and the board of directors look at. FP&A uses it to evaluate pricing decisions, forecasting revenues, and benchmarking it against the competitive hotels. For example, 80% occupancy rate multiplied by a 150 ADR is equal to $120 RevPAR. If a competitor has a $110 RevPAR, then your hotel is capturing more value per room. Remember, rooms matter, but guests often spend on more than just the stay. That's why the next KPI takes the spotlight. Let's talk about hospitality KPI number four, total revenue per available room. The total revenue includes rooms, F&B, spa, events, etc. It captures the total wallet share from the guest and not just the stay cost. Total revenue or TRevPAR helps FP&A teams analyze which revenue streams are growing, like F&B or events, and optimize the resources allocation accordingly. For example, a 200,000 total revenue divided by 1,000 available rooms is $200 TRevPAR. If 40% of that comes from F&B, FP&A can justify investments in restaurants or banquets. Now, revenue is only half the story. What also really matters is how much profit does the hotel keep. That's where our next KPI comes in. Let's talk about hospitality KPI number five, gross operating profit per available room, also known as GOPAR. It is calculated as the gross operating profit divided by the total available rooms. Unlike RevPAR, GOPAR includes cost, so it shows the true profitability. For FP&A, also it is a key budgeting and forecasting tool. FP&A uses GOPAR to compare hotel profitability across portfolios regardless of size. For example, $60,000 gross operating profit divided by a 1,000-room hotel gives you a $60 GOPAR. If RevPAR is strong but GOPAR is weak, FP&A digs into costs like energy, labor, F&B inefficiencies, etc. Now that we have talked about costs, let us also talk about efficiency, how much revenue actually flows into the profit. That's where our next KPI comes in. KPI number six, flow through percentage. This is the percentage of incremental revenue that becomes operating profit. It shows whether the extra sales translate into profit or are getting eaten away by cost. For example, $100,000 revenue increase with a $60,000 profit increase is 60% flow through. A healthy benchmark is often anywhere between 50 to 70% depending on the hotel type. For FP&A, this is used in scenario analysis. If revenue rises by 10%, does the profit rise by 7% or only 2%? A low flow through signals cost leakage. Now, numbers matter, but so also do people. Now, next KPI measures the satisfaction rate, bringing us to hospitality KPI number 7, the guest satisfaction rate, also known as the net promoter score. Guest reviews drive bookings. Online ratings can make or break the hotel occupancy. For example, a hotel with a NPS of 70% enjoys strong loyalty. Fewer discounts are needed to retain guests. A drop in the net promoter score could signal future occupancy risk. FP&A ties guest satisfaction to repeat bookings, marketing spend efficiency, and long term revenue projections. Remember, guest experience is crucial, but so is managing the cost of serving each guest, where our next KPI comes in. Let's talk about hospitality KPI number 8, cost per occupied room, also known as CPOR. It is calculated as the total operating expenses divided by the number of occupied rooms. It tracks how much it costs to host a guest, covering all expenses including housekeeping, utilities, and amenities. For example, a $40,000 operating cost divided by 1,000 occupied rooms gives you a CPOR of $40. If the CPOR is rising faster than the EDR, then the profitability is under threat. FPA team uses CPOR to model cost efficiency and plan staffing levels. Also, comparing CPOR across properties can reveal best practices. Rooms are one thing, but many hotels also earn big profits from food and beverage. So let's measure them in the next KPI. Next, let's talk about hospitality KPI number 9, food and beverage profit margin. Banquets, restaurants, bars often drive more profit than rooms and full service hotels. F&B profit margin is calculated as F&B revenues minus the F&B cost divided by the F&B revenues. For example, if there is a $200,000 F&B revenue and a $140,000 F&B cost, the F&B profit margin in this case is 30%. A hotel with a strong F&B margin may withstand room revenues volatility much better. From FA point of view, it helps allocate investments in outlets, analyze menu profitability, and support pricing decisions. Finally, let's look at a forward looking KPI that helps hotels stay protective, which is the final KPI, the booking pace. Booking pace is the speed at which the reservations are made for the future dates. It can act as an early warning for occupancy trends, which is critical for revenue management. For example, if the next month's forecast occupancy rises from 50% to 65% in 2 weeks, which is strong pickup, the FP&A can adjust the labor and the purchasing to prepare accordingly. FP&A team uses booking pace for doing rolling forecast, staffing models, and cash flow planning. So that is your complete KPI playbook for hospitality industry. Let's do a quick recap. Occupancy, EDR, RevPAR, and TRevPAR measures the revenue health. GoPer, flow through, and C4 reveal profitability and cost control. Guest satisfaction, F&B margin, and booking pace connect guest experience to financial planning. For FP&A professionals, these KPIs aren't just numbers, they are the decision levers which helps them forecast demand, allocate resources, and link the financial outcomes with the guest experiences. Running a SaaS or a software business without tracking KPIs is like driving your car at night with the headlights off. You might be moving forward, but you have no idea where you are going or if you are just about to crash. In this video, I'll walk you through the top 10 SaaS business KPIs that every FP&A professionals must know. And not in a boring textbook style, but in simple practical terms with examples so that you can apply that right away in your role. So let's jump in. Now, before we dive into the KPIs, let us get clear on what SaaS business actually is. SaaS stands for Software as a Service. Instead of selling a product once, companies charge their customers a subscription fee to use their software every month. For example, like Netflix, Zoom, or Canva. And that is why recurring revenue is the lifeblood of SaaS businesses. And the best place to start is the one metric that keeps every SaaS business alive, which is monthly recurring revenue or MRR. Monthly recurring revenue or MRR is the heartbeat of any SaaS business. Without recurring revenues, you don't have predictability. So, in simple words, MRR is just the total money you can count on receiving from subscriptions each and every month. For example, if there are 100 paying customers at $50 each, your total MRR is $5,000. But the real insights come from splitting this MRR into four buckets: new MRR, expansion MRR, contraction MRR, and churned MRR. That tells us where the growth is coming from or where there is a leakage is happening. The new MRR is the revenue added from brand new customers signing up this month. For example, if you get 20 new customers this month who are subscribing at $50 each, then your new MRR is $1,000. Why new MRR matters? It is because it shows the effectiveness of your customer acquisition strategy. Next, let's talk about the expansion MRR. Expansion MRR is the extra revenue from existing customers upgrading, adding more seats, or buying some add-ons. For example, a customer who's an existing customer on a $100 plan upgrades to a $200 plan. In this case, your expansion MRR is additional $100. Expansion MRR matters because it indicates the product value and the upsell success. Often, it is cheaper and healthier to get the customer upgraded rather than chasing new customers. Third, we talk about the contraction MRR. Contraction MRR is the revenue lost when a customer downgrades or reduces its usage. A new customer paying $200 a month moves to a $100 plan. So your contraction MRR in this case is $100. Contraction MRR matters because it is a warning sign that the customers might not see enough value in the higher tier plans. Finally, we come to the churned MRR. This is the revenue lost when customers cancel your service completely. So, in this example, say a $300 monthly paying customer cancels, then your churned MRR is $300. This is the hardest hit to your recurring revenue and reduces both your current and the future potential income. So, breaking it down, your previous month MRR is the MRR that you started the month with. You add the new MRR, which is from the brand new customers. Then you add the expansion MRR, which is extra revenue from existing customers upgrading or adding seats. Then you subtract the contraction MRR, which is revenue loss from customer downgrades. And finally, you subtract the churned MRR, which is lost revenue from cancellations to get to your new month recurring revenue or the new month MRR. Let's take an example. Your previous month MRR was $50,000. New MRR is $5,000. Expansion MRR is $3,000. Contraction MRR is $1,000. And churned MRR is $2,000. In this case, your new monthly MRR grew by $5,000 net in this particular month. Now, if MRR tells us the monthly pulse, then the annual version gives us the big picture health check. The second KPI is annual recurring revenue, also known as the ARR. Investors and boards love ARR because it shows your company's long term strength and stability. In simple words, it is basically MRR multiplied by 12, which is your yearly subscription income. Remember that example, the 5,000 monthly revenue. If you multiply it by 12, you get 60,000, which is your annual recurring revenue. But revenue doesn't just come for free. Let us next talk about how much does it cost to bring in those customers. That brings me to the SaaS business KPI number 3, customer acquisition cost or CAC. SaaS companies often burn cash too fast. The CAC tells you if you are spending too much to get new customers. It is the average amount of money that you spend on marketing and sales to win a single customer. For example, if you spend $10,000 and get 50 new customers, your customer acquisition cost or CAC is $200 per customer. Now, spending to get customers only makes sense if they stick around and pay back more than that you spend on acquiring them. Which brings us to our next KPI. Let's talk about our SaaS business KPI number 4, customer lifetime value, also known as LTV or ELTV. You need to know how much revenue each customer is worth. over their entire relationship with you. So, in simple words, the lifetime value is the total money you will make from a customer before they leave. Let's take an example. If they pay $100 a month and stay for 20 months, that's $2,000 of lifetime value. If your CAC is 200, then you are doing a great job. But customers don't always stay forever. Some will definitely leave. That's why our next KPI becomes critical. So let us talk about SaaS business KPI number 5, which is the churn rate. Churn is the silent killer of SaaS business. High churn means you are filling a leaky bucket. In simple words, a churn is the percentage of customers who cancel in a given time period. For example, if you start with 100 customers and 10 customers cancel in a month, then your churn rate is 10%. Now, churn shows the losses, but what if your existing customers spend more over the period of time? Let's talk about our SaaS business KPI number 6, which is net revenue retention, also known as NRR. This KPI shows if your existing customer base is growing in value or shrinking. In simple words, it is the percentage of revenue you keep from existing customers after upgrades, downgrades, and churn. For example, if you start with $100 and lose $10 from churn, but you are able to add $20 from upsells, then your net revenue retention is 110%. So far, we have looked at customers and revenue, but what about the money you actually keep after all the costs? That's where the gross margin comes in. Next, we talk about the SaaS business KPI number 7, gross margin. High revenue is meaningless if a lot of it is eaten up by costs. So, gross margin shows your actual efficiency. In simple words, it is the percentage of revenue left after paying for all the expenses like hosting, servers, and the customer support costs. For example, if you earn $100 and it costs you $20 to deliver your service, then your gross margin is 80%. Margin looks great on paper, but cash in the bank is what actually matters. That's why let us talk about our next KPI, which is the burn rate and the cash runway. SaaS business KPI number 8, burn rate and the cash runway. Many startups fail not because of poor products, but because they run out of cash. Burn rate is how much money you are losing each month, and the runway is how long you can survive before the cash runs out. For example, if you have $1 million in the bank and you are burning $100,000 a month, you have got a 10-month of cash runway. Now, let us zoom back to the customer level. What's the average value each customer brings in? That is our next KPI. That brings us to SaaS business KPI number 9, which is average revenue per user, also known as ARPU. Average revenue per user helps you understand the customer quality and the effectiveness of your pricing strategy. In simple words, ARPU is your total monthly revenue divided by the number of customers. For example, if your monthly recurring revenue is $50,000 and you have 500 customers, then your average revenue per user or ARPU is $100. Finally, let us bring it all together with one metric that investors use to test SaaS business efficiency, which is our KPI number 10, the magic number. The magic number, also known as the SaaS sales efficiency, is important because it shows your sales and marketing spend is paying off in revenue growth. In simple words, it is the ratio of new ARR added to your sales and marketing spend. For example, if you spend $1 million and are able to add $1 million in ARR, then your magic number is 1. Anything above 0.75 is generally considered healthy. And that is your complete SaaS KPI business toolkit. So let us recap. MRR gives you the short term pulse. ARR is the investor's long term lens. CAC plus LTV shows whether the growth is affordable and profitable. Churn plus NRR reveals if your customer base is stable and expanding. And finally, gross margin, burn, average revenue per user, and the SaaS magic number keeps your efficiency in check. These SaaS business KPIs aren't just numbers, they are the story of your SaaS business. If you understand them well and track them properly, you will lead the business teams with insights instead of reacting to crisis. Every edtech company wants the same thing: more learners, more engagement, and eventually more revenues. But the reality is that most edtech startups fail not because of bad courses, but because they track the wrong KPIs. After spending over 5 years in FP&A for leading edtech companies and now running my own edtech venture, I have seen firsthand which numbers truly drive growth, engagement, and profitability. So, in this video, I'll break down the top 10 edtech KPIs that every learning platform must track to scale sustainably. So, let's dive in. So, let us start with the most visible sign of the edtech company's growth, the new registered learners growth. This measures how fast your platform is attracting new users, and it is the top of the funnel metric that shows brand awareness and market penetration. Let us understand with and help of an example. If your platform had 10,000 registered learners at the end of last month and they become 12,000 learners by the end of next month, that's a 20% growth rate in the total registered learners. For FP&A teams, this metric helps forecast user acquisition, helps set marketing budgets, and also predict when you will be hitting the scaling thresholds. But by having registered learners doesn't mean that they are always active. That's where our next KPI comes in, which is the monthly active free learners. Think about the monthly active learners as your company's engagement heartbeat. It tracks how many free users are actively learning, watching, or interacting with your platform each and every month. Why this matters is because the free users today are your future paid learners. A large and engaged free user base can predict paid conversions in the future potentially. For FP&A teams, we use the monthly active learner trends to model conversion rates, forecast bandwidth needs, and assess the platform stickiness. Now, engagement is great, but sustainability comes from monetization. That's where our next KPI comes in. EdTech KPI number three is your average revenue per learner, also known as ARPU. ARPU shows how much revenues you earn per learner, whether it is through subscriptions, courses, or certifications. For example, if your platform earns $100,000 from 10,000 learners, then your average revenue per user or ARPU is $10. ARPU is the bridge between the growth and monetization. FP&A teams use it to assess the pricing strategy and the revenue per segment, whether it be from free, paid, or from enterprise customers. Now, we have talked about the revenue side. Next, let us talk about the cost side as well. How much are you spending to acquire those learners? That brings us to our KPI number four, customer acquisition cost. Now, CAC tells you the average cost to acquire a new paying learner. For example, if you spend $50,000 on advertisements and acquire 1,000 paid learners, then your CAC or the customer acquisition cost per learner is $50. Now, for FP&A team, tracking CAC helps assess the marketing ROI, helps in budget allocations, and also assess the payback period on the learner acquisition. On a quick side note, if you are serious about growing your career in FP&A, then do check out our Certified Global FP&A Professional Program. CGFPA is a 6-month accredited certification in FP&A designed to help you become real business partners. If that sounds something you would be interested in, links are in the description. Also, there are a bunch of free resources that you can download on FP&A, including books and free courses. You will find all the links in the description. CAC on its own means very little without context. So you also need to know if that learner is actually profitable over the period of time. Which brings us to our EdTech KPI number five, which is the lifetime value, also known as the CLTV or the customer lifetime value. Now, LTV or CLTV tells you how much total revenue you will earn from a learner before they leave the platform or they churn. And the LTV to CAC ratio shows the return on investment for each learner acquired. Let's understand this with the help of an example. If your LTV is $200 and the CAC is $50, in this case, your LTV to CAC ratio is 4 is to 1. I would say that is a healthy ratio. Anything below 3 is to 1 would mean that the acquisition may not be sustainable. Now, LTV to CAC helps you forecast the payback period, marketing efficiency, and the long term profitability. However, not every learner who would be joining the platform would be paying you. So, let us see how many actually convert to paying users every month. That brings us to our next tech KPI. A tech KPI number six is monthly active paid learners. It measures your core revenue generating user base learners who actually pay each month. This is important for FP&A because the monthly active paid learner is a leading indicator of subscription stickiness and success. FP&A teams track monthly fluctuations here to spot churn early. Let's understand this with the help of an example. Say if you have 8,000 users that are active on the platform, but only 800 of them pay. That's a 10% paid conversion, which is a key metric for edtech companies' scalability. Beyond individual learners, many edtech companies also sell to B2B or institutions. So, in the next set of KPIs, let's talk about the enterprise metrics. EdTech KPI number 7 is your enterprise annual recurring revenue, also known as ARR. Now, ARR for enterprises helps you track the number of corporate institutional clients like schools, colleges, or companies that are using your learning platform and the revenue that you generate annually from it. Enterprise contracts helps the company stabilize revenues, and FBA teams uses this to forecast ARR, renewal schedules, and expansion potential. Let's understand this with the help of an example. If there are 10 enterprise clients that are generating $1.2 million of revenue, that equates to 120,000 ARR per client. But just having enterprise customers isn't enough. The real also is whether these enterprise customers renew every year or expand. That's where our next KPI comes in. EdTech KPI number 8, which is net dollar retention. The net dollar retention measures how much recurring revenue you keep and grow from existing enterprise customers. For example, if you start with $100,000 ARR, you lose $10,000 and expand by $20,000. In this case, your net dollar retention is 110%. What that means is the existing customers are spending more, which is a strong retention signal. For FP&A teams, the net dollar retention drives investor confidence and long-term stability for forecasting. Now let's pivot back to the customers, which are the learners, because EdTech company success isn't just about signups; it is also about the learning outcomes. EdTech KPI number 9 is course completion rate. The course completion rate shows what percentage of learners finish the course which they started. It is your most important engagement KPI. For example, if 1000 learners start a course and only 700 finish, then your completion rate is 70%. While this may sound academic, it is financial, which means that the higher completion rate is equal to higher satisfaction, which is better retention, and it leads to more renewals. Now, the next KPI is the opposite of completion rates. EdTech KPI number 10, which is the dropout rate. The dropout rate tracks the percentage of learners who abandon a course midway. For example, if 300 out of the 1000 learners drop out, then your dropout rate is 30%. A high dropout rate signals poor course design or mismatched expectations. FP&A uses this with product teams to project future refunds and the lifetime value decline. That's all the KPIs we discussed. The new learner growth and the monthly active learners track your audience base. The average revenue per user, CAC, and LTV shows financial efficiency. The number of paid learners and the enterprise ARR measure the monetization depth, while the net dollar retention reveals the retention power. The completion and the dropout rates tell you whether the learner is actually engaged and completing the courses. So together, all of these KPIs tell a powerful story of growth, engagement, and profitability for any edtech company. If you found this video helpful, hit that like and subscribe button for more videos like this. Also, don't forget to check out the links for free courses, books, and resources. All the links are in the description. Have you ever wondered why most of the fintech startups fail while only some of them scale up? It is not apart from having a very strong business model. This is because these organizations obsess over the right KPIs that exactly helps them understand when to scale up and when to pull back. So in today's video, I'll be breaking down the top 10 fintech KPIs that drive growth, efficiency, and investor confidence. If you are working in finance or FP&A, these are the KPIs or metrics that you must understand. Before we jump into the KPIs, let us quickly first understand what exactly is a fintech company and why measuring performance here is so different from a traditional finance organization? Fintech simply means financial technology. These are companies that use software, automation, and data to deliver financial services. Now, fintech is not just one kind of business, it's an entire ecosystem. So, let's quickly understand the five major categories of fintech companies and how each one operates. The first type of fintech companies are the payment processors. These are companies that power online and offline payments. For example, companies like Stripe and Razorpay, they help businesses accept card payments, digital wallets, or UPI seamlessly. Their revenue usually comes from charging a very small fee, often less than 1%, on every transaction process. The faster and more reliable their system, the higher is their transaction volumes and revenues. The second type of fintech companies are the digital wallets. These are companies like Paytm and PhonePe, where the users store money digitally and use it to pay for everyday expenses, from groceries to cab rides. These apps thrive on microtransactions and user engagement. They earn from merchant commissions, bill payment fees, and sometimes interest on idle wallet balances. The third type is the P2P lenders such as Lending Club. They connect individual borrowers directly with investors, removing the traditional bank in between. The platform earns through service fees on loans issued or repaid. Their biggest focus is managing risk and maintaining low default rates. Then comes the investment and the wealth management apps like Zerodha, Grow, or Robinhood. They give retail investors access to stocks, mutual funds, crypto, and ETFs in just a few clicks. Their revenue models include transaction fees, subscription plans, or margins on cash balances. Here, the engagement and trust is everything because each trade directly reflects the user confidence. And finally, we have the neobanks, or also known as fully digital banks with no physical branches. These are banks like Bank in the UAE, or Jupiter or Neobank in India, or Chime in the US. They offer traditional banking services like saving accounts, debit cards, payments, and even loans entirely through mobile applications. They make money through interchange fees, lending spreads, or subscription models. Their superpower is their great user experience, instant onboarding, and personalized insights. So, whether you are enabling payments, managing money, lending, or banking, every fintech company relies on core set of metrics that reveal performance, scalability, and profitability. Let's now dive into the top 10 fintech KPIs that truly define their success. Starting with the king of monetization, the first fintech KPI is the average revenue per user. Average revenue per user is how much revenue each active user generates. Your ARPU tells you how well you are monetizing your user base through transaction fees, subscription, interest spreads, or FX markups. For example, if you earn $10 million from 1 million users, your average revenue per user is $10. A 10% lift in average revenue per user is often worth more than 10% new users. For FP&A teams, they use ARPU to forecast revenue growth, model pricing changes, and segment users by profitability. Now, revenue is great, but the revenue solely depends on how smoothly the operation runs. That's where our next KPI comes in. Fintech KPI number two is payment success rate. This one is huge for any payments or a wallet based fintech company. Payment success rate measures how many transactions go through successfully. Each failed payment is lost revenue and poor user experience. Investors and FP&A teams track this very closely to monitor the fintech companies' infrastructure reliability. Even a 1% improvement here can mean millions in extra monthly gross transaction value. FP&A models this to project revenue leakage and technology return on investments. If you are in a lending company, then the biggest risk isn't the failed payments, it is the failed repayments. Fintech KPI number three is the loan default rate. For lending based fintech startups, your make or break metric is the loan default rate. It measures the credit risk and the quality of your underwriting process. Understand with the help of an example. If the company disburses $10 million of debt, and if $300,000 out of that goes bad, your default rate is 3%. For consumer lending companies, that is borderline risky. For FP&A teams, a small rise in the default rate can wipe out the entire profitability. Hence, the finance teams focus on building modeling scenarios like how a 2% increase impacts cash flow, provisioning, and the regulatory capital. Whether you are in lending or transacting, what really matters is Are your existing customers spending more over time? That's where our next KPI comes in, the net revenue retention. Your NRR, or the net retention rate, shows how much recurring revenue you retain from existing customers after upgrades, downgrades, and churn. Anything above 100% means that your customer base is growing organically, even without new customer signups. Let's understand this with the help of an example. Say if your starting base is $1 million in MRR, or monthly recurring revenue, and if you lose $50,000, expand by $150,000, then your NRR, or your net retention rate, is 110%. That is a best in class fintech retention rate. FP&A teams use this metric in investor decks to forecast and show product stickiness and revenue resilience. Now, retention is revenue stability, but let's zoom out and understand how big is your overall flow of money. That is where the next fintech KPI comes in, the gross transaction value, or the GTV. The gross transaction volume is the total value of all the transactions processed on your platform. It is the foundation of your business model. Payment wallets or effect fintech often earn revenue as a very small percentage of the gross transaction volume. GTV forecasts help predict revenue, assess growth momentum, and model seasonality. Now, GTV gives you the volumes, but what percentage of that actually becomes revenue? That is your next fintech KPI, the take rate. The take rate measures how much revenue you earn for every dollar of transaction volume processed. A higher take rate usually means better monetization per transaction, but if you go too high, then your customers may switch to the competition. Let's understand this with the help of an example. For a $5 million revenue on a $500 million gross transaction volume, that is a 1% take rate. Even very small shifts here can massively change your top line. FP&A teams use take rate to do sensitivity analysis and do modeling to optimize pricing without hurting the volumes. What if the customers start leaving? That's when your next fintech KPI comes in, and that is the customer churn. The churn rate measures how many users stop using your product within a given period. Now, acquiring a new fintech user can cost 5 times more than retaining an existing one. For example, if there are 5,000 users that leave your platform out of 100,000, you have a 5% churn rate. For fintech company, anything under 3% is usually healthy. FP&A teams use the churn rate to model retention cohorts and then predict the lifetime value of the customers. Now, next, let us measure the real engagement and not just the signups, but how many users are actually truly active. This KPI tracks how many users perform at least one transaction or log in within a specific period. Inactive accounts don't generate revenues. For fintech companies, the daily and the monthly users show the true engagement. For example, if 80,000 users out of the 100,000 registered users are active, that's a 80% active rate. FP&A teams model active user trends to forecast transaction volumes. This KPI shows costs to process each transaction, including the payment gateway fees, infrastructure, and support. In high value fintech companies, even a few cents saved per transaction can mean millions of dollars in annual savings. FP&A teams use this to monitor efficiency, model unit economics, and optimize the infrastructure investments. And finally, we come to the fintech company's reality check, which is the burn rate, or the cash runway. The burn rate shows how much cash your company spends each month, and the runway shows how long your cash will last. This is the most important survival metric, especially for early stage fintech companies. For example, if your burn is $200,000 a month, and if you have $1.2 million in your bank account, you have a 6 months runway. FP&A teams use this in board reporting, investor updates, and scenario planning. It tells you how many months you can sustain before needing new capital. Now, let's bring everything together. So, there you have it, the top 10 fintech KPIs. The average revenue per user and the take rate measures monetization. The gross transaction value and payment success rate track scale and performance. The NRR and churn reveal retention. The loan default rate controls risk. The cost per transaction shows efficiency, and the burn rate and runway protects your future. Together, these 10 KPIs tells is scaling sustainably or burning cash in silence. Why do some factories run like a well oiled machine, hitting their targets, cutting waste, and maximizing profits, while others struggle with delays, rework, and the rising costs? The key lies in the key performance indicators it tracks that reveal how efficiently your factory converts raw materials into profits. In this video, I'll break down the top 15 manufacturing KPIs that every plant manager, FP&A analyst, and operations leaders should track to improve productivity, quality, and cash flow. Manufacturing KPI number one is gross profit margin. This one tells you how profitable your factory is after covering the production costs. It is calculated by subtracting the cost of goods sold from the revenues divided by revenues into 100. A higher gross profit margin means stronger cost control or better pricing power, and both are signs of good operational health. Now, profit margin is great, but how efficient is your overall manufacturing operations? That is where our next KPI comes in. Manufacturing KPI number two is the operating margin. Now, operating margin looks beyond production and includes all the operating expenses. It is calculated as the operating income divided by revenues multiplied by 100. It shows how well your plant converts sales into profits after paying for overheads like labor, maintenance, and administrative expenses. Now, let us go deeper and understand more about raw material costs. Are they as per your budget or are they not? Manufacturing KPI number three is the material cost variance. This compares your actual material cost to what they should have been. It is calculated by subtracting the actual cost from the standard cost and multiplying it by actual quantity. If your material variance is negative, it is a red flag. Maybe there is waste, poor quality, or supplier price hikes. Now, material efficiency is one thing, but what about managing inventory smartly? That brings us to our KPI number four, which is the inventory turnover ratio. This measures how quickly your inventory moves through the system. This is calculated by taking the cost of goods sold and dividing it by average inventory. A high inventory turnover usually means lean operations, but if the inventory turnover is too low, then it might be a case where you are overstocked and your working capital is tied up. Now, next, let us talk about your machinery and are they performing at their best. Manufacturing KPI number five is the overall equipment effectiveness or OEE. Is the holy grail of manufacturing performance. It is calculated as availability into performance into quality. It shows how close your factory is to perfect production with zero downtime, zero defects, and full speed. Speaking of quality, our next KPI reveals how many good products you actually make. KPI number six is the production yield rate. Production yield rate measures the percentage of units produced correctly the first time. This is calculated as good number of units manufactured divided by the total units produced multiplied by 100. The higher the yield, the better your quality control and lower your rework cost. Now, next, let us zoom into the cost per output. Next, let us zoom into the cost per output. Our manufacturing KPI number seven is cost per unit produced. This tracks how much it costs to produce each item. It is calculated as the total manufacturing cost divided by the total units produced. This helps FP&A teams and operations identify the cost drivers and benchmark across the different lines or plants. Costs are important, but so is delivery. Now, let us measure the reliability next. Manufacturing KPI number 8 is the on time delivery rate. This measures how consistently you meet your promised delivery dates. It is calculated as the number of orders delivered on time divided by the total orders into 100. The high on time delivery builds customer trust, and if there is low on time delivery, you can expect lost businesses and penalties. But what's slowing these deliveries down? Let us find out next. Manufacturing KPI number 9 is the order fulfillment cycle time. This tracks how long it takes from the order receipt to the shipment. The cycle time is calculated as the shipment date minus the order date. Reducing the cycle boosts agility and customer satisfaction. Now, next, let us talk about the silent profit killer, which is waste. Manufacturing KPI number 10 is the scrap and the rework rate. It shows the percentage of defective or wasted products. It is calculated as number of units scrapped divided by the total number of units produced into 100. A high scrap rate usually drains profit and points to process or training issues. Now let us zoom from the production factory to the finance side. Manufacturing KPI number 11 is the cash conversion cycle. Cash conversion cycle shows how long it takes to turn inventory and receivables into cash. The formula is days of inventory outstanding plus days of sales outstanding minus days payable outstanding. The shorter your cash conversion cycle, the healthier your cash flows and more flexible is your business. Now, cash is king, but the energy efficiency can make and break your cost structure. Manufacturing KPI number 12 is the energy cost per unit. Energy cost tracks energy efficiency, which is a big focus in the modern plants. Energy cost per unit is calculated as the total energy cost divided by the number of units produced. Reducing this improves both sustainability and profitability. Now, next, let us take a look at what controls the factory speed. Manufacturing KPI number 13 is the supplier lead time. It measures the time from placing an order to receiving the materials. The lead time is calculated as the delivery date minus the purchase order date. Reliable suppliers means smoother production and fewer stockouts. Our manufacturing KPI number 14 is the first pass yield. It measures the percentage of products that pass the inspection or the quality control the first time. A rising first pass yield means stronger quality and less rework. Now, machines and materials are important, but equally important are the people. That brings us to our final manufacturing KPI number 15, which is the labor productivity rate. It measures how efficiently your workforce is manufacturing the products. Labor productivity is calculated as the total number of units produced divided by the total labor hours. It helps you plan staffing, training, and performance incentives. Every KPI tells a different part of your manufacturing story. When you connect them, the cost, quality, efficiency, and delivery, you get a 360-degree view of your factory's performance. Let us quickly recap. The gross margin and the operating margin shows the profitability. The OEE, yield, and the downtime shows your factory efficiency. The on-time delivery and the cycle time shows reliability. The first pass yield and the scrap rate shows quality. And finally, the cash conversion cycle, the energy rate, and the labor rate shows financial control. If you track them regularly, you will not just make good products, you will master the manufacturing business. Why do some service companies have happy clients? They grow fast, have top tier margins, while other companies lose customers and burn out their teams. The difference lies in tracking the right KPIs. KPIs are the metrics that reveal how efficiently you deliver value, retain clients, and scale sustainably. In this video, I'll break down the top 10 service industry KPIs that every operations, FP&A, and service delivery leader must know, whether you are in IT, consulting, advertising, BPO, or customer support. Unlike manufacturing companies, service businesses do not produce physical goods. They deliver expertise, time, and experience. That's why the success here depends on people's productivity, client satisfaction, and operational efficiency. Get these KPIs right, and your business runs like a well oiled machine. Service industry KPI number one is the billable utilization rate. This is the heartbeat of any service company. It measures how much of your team's time is spent on client billable work. It is calculated as the total billable hours divided by the total available hours. A high utilization rate means that your team is productive and your pricing model is healthy. But if it is too low, then you are paying salaries for idle hours. Now, productivity is just one side of it. The real test is how your client feel about your service. Service industry KPI number two is the Net Promoter Score (NPS) and the customer satisfaction or the CSAT. NPS tells you how likely your customer are likely to recommend your service to others. NPS is calculated by taking the percentage of promoters and subtracting the percentage of detractors. CSAT, on the other hand, measures the satisfaction after a specific interaction. CSAT is calculated as the satisfied responses divided by the total responses. These two metrics reveal your brand loyalty and client experience quality. Now, happy clients stay and the unhappy ones churn. Next, let us measure how many clients actually are retained. Service industry KPI number 3 is the customer retention rate. This measures how effectively you keep clients over time. You can see the formula here on the screen. High retention means strong relationships and dependable recurring revenues, which is a key for subscription and consulting firms. But what happens when a customer faces an issue? That's where our next KPI comes in. Service industry KPI number 4 is the average resolution time, which tracks how long it takes to resolve a customer issue or support ticket. Average resolution time is the total resolution time divided by the total tickets resolved. The shorter this time, the better your service efficiency and client satisfaction. Of course, it is not just about speed, it is also about getting it right on the first try. That brings us to our service industry KPI number 5, first contact resolution. FCR means how many issues are resolved in the first interaction itself without escalation or follow ups. It is calculated as the issues resolved on first contact divided by the total number of issues. A high first contact resolution means stronger processes, a better trained team, a better trained team, and happy customers. Now let us circle back to your people because happy employees drives your profit engine. Service industry KPI number 6 is the employee turnover rate, which tracks how frequently employees leave your organization, which is a critical indicator of morale, culture, and workload balance. Employee turnover is calculated by the employees who left divided by the average number of employees. Divided by the average number of employees. A high turnover in service firm leads to higher hiring costs, lower productivity, and inconsistent client experiences. Service industry KPI number 7 is the revenue per employee, a great measure of productivity and scalability. Revenue per employee is calculated by taking the total revenues and dividing it by the number of employees. Higher revenue per employee usually means stronger pricing, better utilization, and higher value of services. But what if clients start leaving faster than you can replace them? Service industry KPI number 8 is the customer churn rate. Churn is the opposite of retention. Churn shows how many customers you lose in a given period. It is calculated by taking the customers lost divided by the customers at the beginning of the period multiplied by 100. Even a 2% rise in the churn rate can slash your annual profits, especially in a subscription driven model. Even a 2% rise in the churn rate can slash your annual profits, especially in a subscription driven model. Now, with service businesses, usually you have certain commitments with your clients, also known as SLAs. That brings us to our service industry KPI number 9, SLA compliance. SLA compliance measures how consistently you meet the service level agreements, which are your promises on responses or resolution times. SLA compliance is calculated as requests that are met within the SLA divided by the total number of requests. It reflects reliability and client trust, very crucial for IT support, logistics, and BPO industries. Finally, like every service request costs time and money, let us see what it is costing you. Service industry KPI number 10 is the cost per service request, which shows the average cost of resolving a customer issue or completing a service. It is calculated as the total service cost divided by the total requests handled. This helps FP&A and the operation teams find cost saving opportunities without hurting service quality. Now, each of these service industry KPIs tells a story from how efficiently your team works to how satisfied and loyal your customers are. Together, they show the health of your service engine, which is productivity, quality, and profitability. Let us recap the top 10 service KPIs. The billable utilization and the revenue per employees measures productivity. The NPS, CSAT, retention, and churn display your customer experience. The FCR resolution time and the SLA compliance measures the service quality. And your cost per request measures efficiency and profitability. If you track these consistently, then you will transform your service business from reactive to predictive and profitable. If you like this video, then do hit the like and the subscribe button to get more such FP&A video content. Pharmaceutical is one of the most complex industries. It has long cycles, strict regulations, and huge upfront investments. Tracking the right KPIs helps leaders make smarter decisions like when to invest in more trial or where to optimize production. or how to protect their profits post they get the patents. In this video, I'll break down the top 15 pharma industry KPIs that every FP&A, R&D, and operations leaders must master to measure innovation, efficiency, and profitability. So let's dive in, starting with the lifeblood of pharma industry, which is the R&D. Pharma KPI number one is the R&D spend as a percentage of the total revenues. As the name suggests, it measures how much of your revenues is reinvested into research and innovation. It is calculated by taking the total R&D spends and dividing it by the total revenues. FP&A teams use this to benchmark innovation intensity. Higher R&D spends usually signal long-term pipeline strength, but it must also translate into successful medicines and drugs. For example, if a company earns $10 billion of revenues and it spends $2 billion annually on R&D, that's a 20% R&D spend on revenue. Now, spending is one thing and success is another. So, next, let us measure what that investment actually delivers. Pharma KPI number two is the medicine approval success rate, which tracks how many medicines successfully pass clinical and regulatory hurdles. It is calculated by taking the approved number of medicines, dividing it by the total submitted medicines. FPA teams use this to forecast R&D return on investment and assess the pipeline risk. For example, if 5 medicines are approved out of the 20 submitted, that's a 25% success rate. But before a medicine earns revenues, the speed matters, which is how fast can you get it to the market. That brings us to our pharma KPI number three, which is time to market for new medicines, which measures how long it takes from the initial discovery to the commercial launch. It is calculated by subtracting the research start date from the launch date. It matters to FP&A because shorter cycles improve competitive advantage and cash flow timing for FP&A models. Now, let us switch to production, where efficiency directly impacts the profitability. Pharma KPI number four is the manufacturing yield rate. It shows the percentage of high quality output versus the total production. It is calculated by taking the good number of batches and dividing it by the total batches produced. FP&A teams model yield to project waste cost, margin pressure, and efficiency improvements. Now, after talking about the yield rate, we'll move on to the cost side. So, what does it take to produce each batch? KPI number 5 is the cost per batch produced, which measures the total manufacturing cost per production batch. It is calculated by taking the total production cost and dividing by the batches produced. It helps track economies of scale and standardize cost benchmarking across facilities. Next, we go to inventory, which plays a huge role in the pharma, balancing supply and expiry. KPI number 6 is the inventory turnover ratio, which tracks how quickly the inventory moves from production to sale. It is calculated by taking the total cost of goods sold and dividing it by the average inventory. FP&A uses the inventory turnover ratio to manage working capital and reduce write-offs due to expiry. But efficiency means nothing without compliance. So let us measure that next. Pharma KPI number 7 is the regulatory compliance rate, which tracks adherence to the industry regulations and GMP standards. It is calculated by taking the compliant audits and dividing it by the total audits. Non compliance leads to fines, recalls, and loss of investor confidence, which is a key FP&A risk factor. Now that we have ensured compliance, next let us talk about the sales performance. KPI number 8 is the sales growth by product or region, which shows revenue growth segmented by product line or geography. It is calculated by taking the current period sales minus the previous period sales divided by the previous period sales into 100. FP&A uses this for sales forecasting, portfolio prioritization, and market expansion decisions. But not all medicines are equally profitable. Let us measure gross margins per product next. On a quick side note, if you are serious about growing your career in FP&A, then do check out our Certified Global FP&A Professional Program. CGFPA is a 6-month accredited certification in FP&A designed to help you become real business partners. If that sounds something you would be interested in, links are in the description. Also, there are a bunch of free resources that you can download on FP&A, including books and free courses. You will find all the links in the description. KPI number 9 is the gross margin per product line, which shows profitability by product. It is calculated as revenues minus COGS divided by the revenues into 100. FP&A teams use this for SKU level profitability and pricing strategy. After discussing profitability, next let us talk about safety and quality, which are two critical trust pillars in the pharma industry. Pharma KPI number 10 is the adverse event reporting rate, which measures the frequency of reported side effects relative to total prescriptions. It is calculated by taking the adverse events divided by the total prescriptions into 100. FP&A teams monitor this for potential legal compliance or recall cost exposure. Speaking of trials, let us also check how well clinical phases perform. KPI number 11 is the clinical trial success rate, which tracks the percentage of clinical trials that meet the desired endpoints. It is calculated by taking the successful trials and dividing it by the total trials. A high trial success means lower sunk R&D costs and faster time to market. Now, let us see if that research actually pays off. Pharma KPI number 12 is the return on R&D investments, also known as RORI. It measures the financial return generated from the R&D spending. RORI is calculated by taking the gross profit from the new medicines, dividing it by the total R&D spent into 100. FP&A uses RORI to decide future funding allocation across medicine portfolios, but even successful products can stumble through recalls. That brings us to our pharma KPI number 13, which is the product recall rate, which tracks the frequency of the product recalls due to quality or safety issues. It is calculated by taking the recalled batches, dividing it by the total batches. Recall hits brand trust and creates massive financial liabilities. FP&A must model these scenarios. Once medicines are made, speed to market depends on your distribution. Pharma KPI number 14 is the distribution lead time, which measures how long it takes to deliver finished medicines to distributors or pharmacies. It is calculated as delivery date minus the dispatch date. Shorter lead times improve customer satisfaction and reduce holding costs. And finally, the silent threat to every pharma company is the patents. That brings us to our final pharma KPI number 15, which is patent expiry impact, also known as revenue at risk. It estimates revenue vulnerable to patent expirations. It is calculated by taking the revenue from expiring patents and dividing it by the total revenues. FP&A uses this to model patent cliffs when generic medicines enter and erode sales. From R&D to regulatory, from manufacturing to market, these KPIs together give a 360-degree view of the pharma company's performance. FP&A teams connect these metrics to tell one powerful story: how science translates into sustainable financial outcomes. Let's do a quick recap. We first talked about innovation KPIs like the R&D percentage, RORI, drug and trial success rates, and time to market. We then move to operational KPIs like the yield and the cost per batch, downtime, inventory, and compliance. We also talked about the commercial KPIs like the sales growth, gross margin, distribution, and patent impact. Finally, we talked about quality and risk KPIs like the adverse events and the recall rate. These tracked on a consistent basis will help FP&A team not just report performance but also how to predict and help the business teams make faster decisions. Hope you enjoyed the breakdown of the top 15 pharma company KPIs. For more such FP&A videos, do like and subscribe to our channel. Also, don't forget to check out a bunch of free resources, including free courses, books, and cheat sheets. All the links are in the description. Construction is a very high risk industry. Complex projects, fluctuating material costs, labor shortages, and safety hazards. KPIs connect the construction planning with the performance so that the leaders can detect early warning signs before they become costly overruns. In this video, I will break down the top 15 construction industries KPIs that every project manager, FP&A analyst, and contractor must know. But before we dive into the KPIs, let's quickly understand how construction companies actually work, because these KPIs only make sense when you see the full picture. A construction project usually moves through five major stages. The first stage is the project bidding and estimation. Companies compete for contracts by estimating costs, timelines, and margins. This is where pricing accuracy and bid hit ratios play a huge role. The second stage is planning and design. Teams finalize drawings, materials, subcontractors, budgets, and schedules. Any error here becomes a cost overrun later. The third stage is procurement and mobilization. Materials, machinery, and labors are arranged. Delays or price fluctuations at this stage directly impact project profitability. The fourth stage is construction and execution. This is the heart of the operation, coordinating labor, equipment, safety, quality, and daily progress. And finally comes the last stage, which is handover and closeout. Final inspections, punch list completion, compliance checks, and final reconciliations happen at this stage. This is where the profitability is locked in. Construction industry has thin margins, high risk, and long project cycles. That's why KPIs aren't just numbers. They are early warning signals that can save millions of dollars. Now that we understand how the construction life cycle works, let us dive into the KPIs that actually measure performance. Starting with the biggest one, which is the project cost variance. Construction KPI number one is the project cost variance and the schedule variance. First, let us talk about the project cost variance. It measures the difference between the planned cost and the actual cost. It is calculated as the budgeted cost minus the actual cost. FP&A monitors this daily to track overruns and adjust the forecast. For example, budget is $5 million, but the actuals turn out to be $5.5 million. That's a $0.5 million variance over the budget. Also, similarly, we track the schedule variance, which tracks how far ahead or behind schedule your project is. Schedule variance is calculated as the planned duration minus the actual duration. Delays increase labor and equipment costs. FP&A uses this in the project reviews. Next, let us move to the performance indices that combine both cost and schedule. We talk about cost performance index and schedule performance index one by one. But first, let us talk about the cost performance index, also known as the CPI. The CPI shows how efficiently the project is using its budget. It is calculated as the earned value divided by the actual cost. If the CPI is less than 1, that means that we are overspending, which is a red flag for FP&A and the project control teams. But cost performance is only half the story. What about the time performance or the schedule? That's where the schedule performance index or SPI comes in, which measures whether the project is ahead or behind schedule. SPI is calculated as the earned value divided by the planned value. If SPI is less than 1, it indicates delays, which FP&A translates into future cost increases. Next, let us measure the productivity of your most important assets, which is your people. Construction KPI number 3 is the labor productivity. Labor productivity tracks output relative to labor hours. It is calculated as the labor output divided by the labor hours. Low productivity signals inefficiencies, skill gaps, or delays, directly affecting cost per square feet. And what about the machines? They cost money whether they are used or not. That brings us to our construction KPI number 4, which is the equipment utilization rate, which shows how effectively equipments are being used. It is calculated as the actual usage hours divided by the total available hours into 100. FP&A uses this to optimize rentals, maintenance cycles, and asset ROI. Construction sites are a very high risk zone. So let us measure safety next. Construction KPI number 5 is the safety incident rate, also known as the TRIR. It tracks incidents per 200,000 labor hours. TRIR is calculated as incidents multiplied by 200,000 divided by the total labor hours. A high TRIR increases insurance costs and delays. FP&A models this into the project risk. Next, let us look at the KPI that often signals scope creep, and that is the change order frequency, which measures how often the client or the contractor changes the project scope. The change order frequency is calculated as the number of change orders divided by the total project. Frequent changes cause delays and budget inflation, which is a major FP&A risk factor. Now, profitability is the ultimate indicator, so let us measure it next. Construction KPI number 7 is the project profit margin. It shows profitability after all project expenses. It is calculated as the project profit divided by the project revenues into 100. FP&A teams use this to judge bidding strategy, cost control, and contractor performance. Now, next, let us move to the silent profitability killer, which is rework. Construction KPI number 8 is the rework cost percentage, which is measured as how much project cost is lost to rework. Rework percentage is calculated as the rework cost divided by the total project cost into 100. High rework destroys margins, and FP&A teams use this to justify training or quality investments. Rework often comes from waste. Next, let us measure that too. Construction KPI number 9 is the materials waste percentage, which tracks how much material is wasted versus total purchase. It is calculated as the waste materials divided by the total materials purchased. Waste inflation directly raises the project cost. FP&A uses this to negotiate supplier terms. Next, let us look at the strategic side, which is winning new business. Construction KPI number 10 is the bid hit ratio, which measures how many bids you win versus how many you submit. Bid hit ratio is calculated as the winning number of bids divided by the total bids. It helps FP&A evaluate which types of projects are the most profitable to pursue. Now, winning is good, but execution relies on subcontractors. That brings us to our construction KPI number 11, which is the subcontractor performance rating, which assesses the subcontractor quality, timelines, and cost control. It is a rating scale on a scale of 1 to 10 based on the performance criteria. Poor subcontractors can increase delays, rework, and cost overruns. That is why it is important. Next, let us look at a KPI that defines the project scale and efficiency, which is the project duration. The construction KPI number 12 is the average project duration, which measures the average time required to complete a project. It is calculated as the total duration of all the projects divided by the number of projects. Long durations tie up cash flow and reduce capacity for new projects. Speaking of future capacity, let us measure your upcoming workload, which is our construction KPI number 13, construction backlog, also known as the value of future work. It shows the value of contracted work not yet started. It is calculated as the sum of all awarded but uncompleted contracts. FP&A uses backlog to forecast revenue, labor needs, and cash flow for the next 24 to 36 months. Next, let us measure how efficiently your assets generate returns, which is our construction KPI number 14, return on construction assets, also known as ROCA. It shows the profit generated per dollar invested in construction equipment and assets. ROCA is calculated as the net profit divided by the total construction assets. FP&A uses ROCA to decide whether to rent or to buy equipment. And finally, the KPI that tells you how close you are to the project completion. Construction KPI number 15, the punch list completion rate, which measures how many punch list items are completed before handover. Items divided by the total punch items into 100. High completion rate means fewer delays, faster handovers, and quicker revenue recognition. These 15 KPIs cover the entire construction life cycle: cost, time, productivity, safety, financial health, and customer success. FP&A teams use them to forecast cash flow, evaluate risk, predict margins, and support smarter project decisions. Let us do a quick recap. We started with performance KPIs like the CPI, SPI, the cost and the schedule variance, and the duration. Next, we moved on to the financial KPIs like the profit margin and the return on construction assets. We also discussed the operational KPIs like the productivity and rework. We talked about the business development KPIs on the backlog and the bid hit ratio. And finally, we talked about the quality and safety KPIs like the safety rate and the subcontractor rating. If you track these KPIs consistently, your construction business becomes predictable, scalable, and more profitable. Hope you enjoyed this breakdown on the top 15 construction KPIs. Why do some of the hospitals deliver world class care, shorter wait times, and strong financial performance, while others struggle with patient complaints, overcrowding, and rising costs? One of the key differences lies in tracking the right KPIs, both financial and operational numbers that connect quality of care, operational efficiency, and financial stability. Today, I am going to break down the top 15 healthcare KPIs that every hospital director, operational leader, and FP&A professional must track. So let us dive in. Hospitals deal with high patient expectations, strict compliance, unpredictable demand, and huge staffing costs. KPIs help hospitals improve care quality, reduce risks, optimize resources, and maintain financial health. Before we jump into the KPIs, let us quickly understand how a hospital actually operates because every KPI ties back to one of these core functions. A hospital typically runs across five major operational pillars. The first one is the patient intake and triage. This is where the patients arrive, register, get assessed, and are directed to emergency OPD or inpatient care. KPIs like the wait time and ER wait time come from here. Second is the clinical diagnosis and treatment. Doctors, nurses, specialists evaluate symptoms, run tests, and administer treatments here. Metrics like treatment accuracy, medication error rate, and HAI rate are born here. Third is the inpatient care and bed management. Patients who need monitoring stay admitted. This drives KPIs such as bed occupancy, ALOS, and patient to staff ratio. Fourth is the support services and operations. This covers the pharmacy, labs, radiology, housekeeping, and nutrition that help the hospital run smoothly. This affects KPIs like cost per patient visit and the overall care quality. And finally, we come to the fifth, which is discharge and follow up and retention. Patients leave the hospital, but their experience continues through follow ups and long term care. Your KPIs such as patient satisfaction, readmission rate, and retention rate connect. Hospitals balance the toughest combination of pressures, which are patient outcomes, staff workload, regulatory standards, and financial sustainability. That's why KPIs matter so much. They show exactly where the care is strong and where is the risk rising. Now that we have the full picture of how a hospital operates, let us next dive into the KPIs that truly define performance, starting with the most important one, which is the patient satisfaction score. The patient satisfaction score is equivalent to the CSAT. It measures how satisfied patients are with the care that they have received. It is calculated by taking the total satisfied responses divided by the total responses. It matters because higher satisfaction boosts reputation, retention, and insurance reimbursements. For example, a CSAT of 92% signals strong hospital service quality. Now, satisfied patients matter, but so does how long they had to wait. Hospital KPI number two is the average patient wait time, which tracks how long patients wait before receiving the care. The formula here is the time of consultation minus the time of arrival. This matters because long waits can cause dissatisfaction, overcrowding, and overall lower operational efficiency. Next, let us measure how effectively you are using your most limited resources in the hospital, which are the beds. Healthcare KPI number three is the bed occupancy rate, which shows the percentage of hospital beds that are occupied. It is calculated by taking the occupied number of beds divided by the total beds. If the occupancy is too low, which means there is underutilization, but when it is too high, then it could result into patient bottlenecks. FP&A uses this for revenue forecasting. Now, let us measure an outcome every hospital wants to reduce, which is readmission. Healthcare KPI number four is the readmission rate, which tracks how many patients return within a set period, usually 30 days. Readmission rate is calculated by taking the readmitted number of patients divided by the total discharges. It matters because high readmissions signal poor care quality. Insurance companies usually penalize hospitals for this. Next, let us measure how long patients stay, which is also a major cost driver. Healthcare KPI number five is the average length of stay, which shows the days a patient stays in the hospital. It is calculated by taking the total inpatient days divided by the total number of discharges. For FP&A teams, they track allos to optimize staffing, bed turnover, and cost per patient. Next, let us look at the staffing, which is one of the biggest costs in the healthcare industry. The patient to staff ratio measures how many patients each staff member is handling. It is calculated as the total number of patients divided by the total clinical staff. High ratio here leads to burnouts, errors, and poor patient experience. Now, next, let us measure the clinical quality of the care provided. Hospital KPI number seven is the treatment accuracy rate, which tracks how many treatments or procedures were performed currently the first time. It is calculated as the correct number of treatments divided by the total treatments. Errors lead to complications, higher costs, and lower patient trust. Another quality KPI for the healthcare industry is the one that every hospital fears, which is the infections acquired inside the hospital. Hospital KPI number 8 is the hospital acquired infection rate, also known as the HAI rate, which measures how many patients get infections during their stay at the hospital. It is calculated by taking the HAI cases divided by the total admissions. High HAI rate damages reputation and can bring legal and insurance penalties for the hospital. Next, let us talk about the pressure zone of every hospital, which is the ER. Healthcare KPI number 9 is the emergency room wait time, which tracks how long patients wait before being seen in the emergency room. It is calculated as the triage start date minus the ER arrival. Long emergency room delays signal staffing gaps or bed shortages and cause critical patient risk. But none of this works without the staff retention ratio. KPI number 10 for hospitals is the staff turnover rate. It shows how often hospital staff leave. It is calculated by taking the staff exits divided by the average staff count. Healthcare turnover is expensive and replacement cost is 2 to 3 times the annual salary. Now, let us return to the patients. The hospital KPI number 11 is the patient retention rate, which shows how many patients return for future care or follow ups. The retention percentage is calculated by taking the returning number of patients and dividing it by the total patients. Why this matters for FP&A is because loyal patients improve the long term revenue and trust for the hospital. Healthcare and hospital KPI number 12 is the medication error rate, which tracks how often medication mistakes occur. The error rate is calculated by taking the medication number of errors divided by the total prescriptions. FP&A teams model this for risk cost, liability, and training investments. Now, let us move into the financial KPIs, starting with how much it costs to treat a patient. Hospital or healthcare KPI number 13 is the cost per patient visit, which shows the total cost of delivering one patient visit. Cost per patient visit is calculated by taking the total operating cost divided by the total patient visits. It matters because it helps hospitals optimize efficiency, pricing, and next is the KPI that ties beds to the revenues. Bringing us to the KPI number 14, which is revenue per available bed, which measures how profitable each hospital bed is. It is calculated by taking the total revenues dividing by the total available beds. FP&A uses this to plan capacity, expansion, and service mix. And finally, an outcome that every hospital aims to reduce, KPI number 15, which is the mortality rate, which tracks the percentage of patients who pass away while under the hospital care. The mortality percentage is calculated by taking the patient deaths divided by the total admissions. This is a critical quality of care indicator monitored by regulators, insurers, and accreditation bodies. From patient satisfaction to wait times, from infection control to financial KPIs, these metrics give hospitals 360-degree view of operations, care quality, and profitability. FP&A connects them to answer the most important question: are we delivering great care efficiently and sustainably? Let us do a quick recap. We started with discussing the patient experience KPIs like the CSAT, the wait time, the emergency room wait time, and the retention. We then moved to the operational efficiency KPIs like the bed occupancy, the average length of stay, the patient to staff ratio. We then talked about the clinical quality KPIs like the treatment accuracy, the HAI, the readmission, and the medication rate. Finally, we talked about the financial performance KPIs like the cost per visit, the revenue per bed, or the staff turnover. Track these consistently, and your hospital becomes safer, more efficient, and more financially resilient. Why do some e commerce brands scale to eight figures with predictable growth while others drown in rising ad costs, abandoned carts, and shrinking margins? The secret lies in monitoring the right key performance indicators. These are numbers that reveal how well your website converts traffic into revenues and first time buyers into loyal customers. Today, we are going to cover the top 15 e commerce KPIs that every founder, FP&A analyst, and growth marketer must know. Now, before we jump into the e commerce KPIs, let us first quickly understand the core engine of an e commerce business because these KPIs map directly to this journey. E commerce companies run across 5 major stages. Stage 1 is the traffic generation. This includes paid ads, SEO, social media, influencers, everything that drives visitors to the site. KPIs like website traffic, return on ad spend, and revenue per visitor means a lot here. Stage 2 is the website engagement. Visitors browse, click, view products, and move through the funnel. This drives KPIs like conversion rate, traffic to lead rate, and cart abandonment. Stage 3 is purchase and checkout. This is where money changes hand or where customers drop off. KPIs like average order value, checkout completion, and CAC come from here. This is followed by stage 4, which is fulfillment and delivery. Inventory, warehousing, packaging, and shipping. KPIs like stockout rate, fulfillment accuracy, and on time delivery matter a lot here. And finally, we come to stage 5, which is retention and loyalty. Repeat purchases, refunds, customer experience, and long term value. KPIs like lifetime value, repeat purchase rate, and CSAT NPS sit here. Now that we understand how an e commerce business works end to end, let us dive into the top 15 e commerce KPIs that actually drive growth. Starting with the biggest one, which is the conversion rate. The conversion rate measures how many website visitors turn into paying customers. It is calculated by taking the purchases divided by the website visitors. For FP&A, small improvements here can dramatically increase revenue without increasing traffic. E-commerce KPI number 2 is the average order value, which shows the average amount spent per order. It is calculated by taking the total revenue and dividing it by the total number of orders. For FP&A team, higher average order value boosts profitability driven by bundles, upsells, and volume discounts. Next on our list is the customer acquisition cost, also known as CAC. CAC measures how much you spend to acquire one customer. It is calculated by taking the total marketing spend and dividing it by the total customers. For FP&A, rising CAC lowers margin, and we use this to model break even and pricing. Very much related to CAC, we have our e-commerce KPI number 4, which is the customer lifetime value, also known as LTV. It shows the total revenue a customer generates over their lifetime. LTV is calculated by taking the average order value and multiplying it by the purchase frequency and the retention period. For FP&A, we compare LTV to CAC to tell if the growth model is sustainable or not. Next comes the e-commerce KPI number 5, the cart abandonment rate. This tracks how many customers add items to the cart but don't complete purchases. This is calculated by taking the abandoned carts, dividing it by the total number of carts. For FP&A, high abandonment signals checkout friction and costing lost revenues. Related to cart abandonment, we go to our e-commerce KPI number 6, which is the checkout completion rate. This measures how many customers finish the checkout process, and it is calculated by taking the completed checkouts divided by the checkout starts. For FP&A, even a 1 to 2% improvement here increases daily sales dramatically. Next on the list, we have e-commerce KPI number 7, which is the website traffic, which shows the number of visitors reaching out on your website. Traffic drives the top of the funnel, but it only matters with strong conversion. The next KPI that we have on our list is the traffic to lead rate, which measures how many visitors give you their email or sign up. Lead rate is calculated by taking the total number of leads generated divided by the website visitors. Growth teams use this to forecast retargeting and email driven strategies. The next KPI is a big one, which is the revenue per visitor, which shows how much revenue each visitor generates. Revenue per visitor is calculated by taking the total revenues, dividing it by the website visitors. This combines conversion rate and average order value to measure the total funnel efficiency. Next, we will talk about an important metric for marketing teams, which is return on ad spends, also known as ROAS. ROAS measures marketing efficiency. It is calculated by taking the revenue from ads and dividing it by the total ad spend. It helps FP&A decide which campaigns to scale or kill. Next on our list, we have our e-commerce KPI number 11, which is the repeat purchase rate, which shows how many customers buy more than just once. Repeat purchase percentage is calculated by taking the repeat customers, dividing it by the total customers. Higher repeat rate reduces CAC dependency and strengthens LTV. Now, revenue and return on marketing spends are important KPIs, but so is equally important refund and return rate, which tracks the percentage of orders that are returned. It is calculated by taking the number of returned orders, dividing it by the total orders. High return rate destroy margins, especially in apparel and electronics. That brings us to our e-commerce KPI number 13, which is the stock out rate, which shows how often products go out of stock. And it is calculated by taking the stock out, dividing it by the total days listed. Stockouts kill sales and damages LTV. FP&A uses this to optimize inventory planning. Another important e-commerce KPI is the fulfillment accuracy. It measures how often orders are picked, packed, and shipped correctly. It is calculated by taking the correct number of orders delivered by the total orders. Errors create returns, refund, and negative reviews, which increases costs. Finally, we come to KPI number 15, which is the on time delivery rate, which shows how reliably orders arrive as promised. On time percentage is calculated by taking the number of on time deliveries, dividing it by the total number of deliveries. Late deliveries reduce repeat purchases and lowers NPS and CSAT. Although we talked about 15 KPIs, but here is one last final bonus KPI, which is the customer satisfaction rate. It measures how happy customers are and whether they'd recommend you. CSAT is calculated by taking the satisfied responses and dividing it by the total responses. And NPS is calculated by taking the percentage of promoters, subtracting the percentage detractors. For FP&A, strong CSAT and NPS drives higher LTV and lower churn. These e-commerce KPIs cover the entire customer journey from attracting visitors to converting them, fulfilling orders, and building lifetime loyalty. FP&A teams combine these metrics to answer critical questions like, are we growing profitably? Are acquisition costs rising faster than the revenue? Is fulfillment hurting customer retention? Let us do a quick recap. Conversion KPIs include the conversion rate, checkout completion, and revenue per visitor. Next, we discussed the customer value KPIs, including the average order value, lifetime value, and the repeat purchase rate. We also discussed the marketing KPIs, including the CAC, ROAS, and traffic. We also talked about operational KPIs like the stock out rate, fulfillment accuracy, and on time delivery. Finally, we looked at some customer experience KPIs like the NPS, CSAT, and the refund rate. Track these consistently, and your e commerce business becomes scalable, predictable, and highly profitable. Cars. They may look like simple machines on the outside, but behind every new car model, there is a complex world of engineering, suppliers, factories, and dealerships working in perfect sync. In today's video, we will break down the top 15 automobile industry KPIs that every analyst, plant manager, and automobile leader must master. Before we jump into the KPIs, let us quickly understand the automotive value chain because these KPIs map directly to every stage of it. Automobile companies operate across five major phases. The first phase is the production planning and assembly. Vehicle manufacturing involves stamping, welding, painting, and assembly, each with strict time and quality standards. KPIs like OEE, capacity utilization, first pass yield arise from here. Then comes the second phase, which is supplier management and inbound logistics. Hundreds of components come across various vendors like engines, electronics, seats, tires. Your KPIs like supplier lead time and supplier defect rate matter a lot. Stage 3 is the sales and distribution. Vehicles move to dealerships, distributors, and end consumers. Your KPIs like the order fulfillment time, on time delivery, and ASP matter. Stage 4 is the customer ownership experience. Warranties, service centers, and repairs shape long term customer loyalty. Your KPIs like warranty claims, recall frequency, and service turnaround time reflect this. And finally, stage 5 is market growth and competitiveness. Automakers measure brand strength and sales efficiency. KPIs like sales conversion rate, market share, and CSAT come from here. Now that we understand the automobile value chain, let us next dive into the KPIs that truly determine performance, starting with the production volume and capacity. Automobile KPI number one is the production volume and capacity utilization rate. This tracks how many vehicles you produce and how efficiently your plant uses available capacity. It is calculated by taking the actual output, dividing it by the maximum capacity. Higher utilization lowers cost per vehicle and improves margin. But just producing isn't enough. The question also comes how efficiently machines are working. KPI number two is overall equipment effectiveness, also known as OEE. This is a gold standard metric for automobile plant efficiency. It is calculated by taking the availability multiplied by performance into quality. For FP&A teams, even a small OEE improvement translate into millions of production savings. Our automobile KPI number three, which is the first pass yield and defect rate. First pass yield measures how many units pass inspection with no rework. It is calculated by taking the good number of units, dividing it by the total units produced. High defects increase rework cost, warranty exposure, and brand damage. A vehicle may leave the factory perfectly fine, but what happens after customers start using it? That also tells a deeper story. That brings us to our automobile KPI number four, which is the warranty claim rate, which tracks how often customers file warranty claims. Warranty claim rate is calculated by taking the total warranty claims, dividing it by the total vehicles sold. Rising warranty costs reduces gross margins and signals quality issues. And when the warranty issue arises, they often lead to an even more damaging outcome. So let us talk about our KPI number 5, which is the recall frequency. This measures how often a model requires safety or quality recalls. Recall percentage is calculated by taking the total number of recalled vehicles, dividing it by the total vehicles sold. Recalls damages trust, increases cost, and impact investor confidence. Recalls affect reputation, but they also disrupt timelines, which brings us to our next KPI. On number 6, we have is the order fulfillment cycle time, which tracks how long it takes from receiving an order to delivering the vehicle. Cycle time is calculated by taking the delivery date and subtracting the order date. Faster cycle improves cash flow and customer satisfaction. Now, speed matters, but speed without reliability can cost sales and trust. Which brings us to our KPI number 7, which is the on time delivery rate. On time delivery rate measures delivery reliability to dealerships or customers. It is calculated by taking the total on time deliveries, dividing it by the total number of deliveries. Delays cause lost sales and dealership penalties. Deliveries heavily depend on parts, and that takes us straight to our supplier performance KPIs, which is in the next section. On a quick side note, if you are serious about growing your career in FP&A, then do check out our Certified Global FP&A Professional Program. CGFPA is a 6-month accredited certification in FP&A designed to help you become real business partners. If that sounds something you would be interested in, links are in the description. Also, there are a bunch of free resources that you can download on FP&A, including books and free courses. You will find all the links in the description. Automobile KPI number 8 is the supplier lead time. Supplier lead time tracks the time suppliers take to deliver the spare parts. It is calculated by subtracting the purchase order date from the delivery date. Long lead times reduce production flexibility and create bottlenecks. Speed of supply is one thing, and the quality of supply is another. Automobile KPI number 9 is the supplier defect rate. The supplier defect rate shows the percentage of defective components received from the supplier. The percentage defect is calculated by taking the defective parts and dividing it by the total parts received. Supplier issues increases rework, scrap and downtime. And poor parts don't just cause rework. They inflate the very number every CEO watches closely, which is the cost per vehicle produced and the gross margin per vehicle. This tracks the total manufacturing cost per unit and the profit earned. Now, how it is calculated? Cost per unit is the total manufacturing cost divided by the units produced, and gross margin is the vehicle revenue minus the vehicle cost divided by the vehicle revenue. These are core metrics for profitability analysis and pricing decisions. Margins tell us if the company is profitable, but profits start before the sale is even made. That brings us to our automobile KPI number 11, which is the sales conversion rate. It measures how many leads or showroom visitors convert into buyers. It is calculated by taking the number of vehicles sold in the showroom divided by the number of leads or the number of customer walk-ins. It shows team effectiveness and the funnel efficiency. The next automobile KPI on our list is the average selling price, also known as the ASP. ASP tracks the average revenue per vehicle sold. It is calculated by taking the total sales revenue and dividing it by the total number of units sold. Higher average selling price improves margins influenced by trims, packages, and upsells. Moving on, the next KPI we have on our list is the market share, which shows your share of the total automobile market. Market share is calculated by taking your automobile sales, dividing it by the total market sales. It signals brand competitiveness and drives long term planning. Owning the market share is impressive, and keeping customers happy is what sustains it. That brings us to our KPI number 14, which is the customer satisfaction, also known as the CSAT. CSAT measures post purchase satisfaction with the buying and the ownership experience. It is calculated by taking the satisfied responses and dividing it by the total responses. A high customer satisfaction score improves referrals, repeat sales, and brand loyalty. Now, satisfaction doesn't stop at buying. It continues every time the customer needs your service. That brings us to our final automobile KPI, which is the service center turnaround time. This tracks how long the vehicles spend inside the service centers. Turnaround time is calculated by taking the delivery date and subtracting the service drop off date. Faster service improves customer satisfaction and increases workshop profitability. These KPIs cover the every stage of the automotive ecosystem, right from stamping steel in the plant to managing suppliers to delivering the vehicles and to servicing customers. FP&A team relies on these numbers to forecast production, analyze margins, improve quality, and plan long-term strategy. Let us do a quick recap. We started with the manufacturing KPIs like the OEE, first pass yield, defect rate, and cost per vehicle. Then we discussed the supply chain KPIs like the supplier lead time, supplier defects. We also talked about the distribution KPIs like the fulfillment cycle time and on time delivery. Also, we talked about sales and marketing KPIs like the conversion rate, average selling price, and the market share. We also discussed about customer experience KPIs like the CSAT, warranty claims, and service turnaround. If you track these consistently, you will run an automobile business that's efficient, profitable, and customer centric. If you enjoyed this breakdown of the top 15 automobile industry KPIs, then do like this video and subscribe to our channel for more such FP&A videos. Also, don't forget to check out a bunch of free resources on FP&A, including books, cheat sheets, and free courses. All the links are in the description. Why do some insurance company grow steadily, maintain strong underwriting profits, and stay financially secure for decades, while others struggle with high claims, policy lapses, and poor investment returns? The difference lies in tracking the right key performance indicators. These are metrics that reflect risk, customer behavior, operational efficiency, and long-term profitability. In this video, we are going to cover the top 15 insurance industry KPIs that every FP&A analyst, actuary, and insurance leader must master. Before we jump into the KPIs, let us quickly first understand how insurance companies operate, because every insurance KPI maps to the system. Insurance industry runs on these three fundamental engines. The first one is the underwriting and risk selection. This is where the insurance company evaluates applicants, price policies, and decide whether to accept the risk or not. In this stage, KPIs like loss ratio, combined ratio, claims frequency, and severity are very important. The second stage is the customer life cycle, which includes the sale of policies, renewals, and claims. Policies are usually either sold through agents or brokers or to B2C insurance applications and websites. In this stage, KPIs like retention, CAC, lapse rate, and NPS are very important. The third and the final stage in the insurance industry life cycle is the investment of the premium float. Insurance companies invest premiums before the claims are paid. These could be invested in bonds, equities, and other long term assets. KPIs here tracked are the investment yield, solvency ratio, and embedded value. Insurance profitability comes from two places. One is the underwriting performance, and the second is the investment returns. These KPIs connect both the sides. Now that we understand how insurance companies work, let us dive into the key performance indicators that determine profitability. Starting with the most fundamental one, the loss ratio. The loss ratio measures how much of the premium is paid out as claims. It is calculated by taking the claims incurred divided by the premiums earned. If the loss ratio rises, pricing must increase or underwriting rules must be tightened. The next on the list is the expense ratio. The expense ratio shows how operating expenses are as a percentage of the premiums. Expense ratio is calculated by taking the operating expenses and dividing it by the premiums earned. For FP&A, high expense ratios indicate inefficient operations or costly distribution channels. Next up is the insurance industry KPI number 3, which is called the combined ratio. This metric brings together two important pieces, the loss ratio and the expense ratio, to show an overall underwriting performance. The formula is simple. Combined ratio is equal to the loss ratio plus the expense ratio. And here is how you can interpret it. A combined ratio under 100% means that we are generating an underwriting profit. At 100% or above, that means that the company is operating at an underwriting loss. For FP&A, this is important because the combined ratio is one of the core profitability KPIs which reflects the performance of the company's underwriting operations without factoring in the investment income. It gives us a clean, direct look at how the insurance business is performing on its own. Insurance industry KPI number 4 is the premium growth. It tells us whether our gross return premium or net return premium are growing. This metric measures how quickly our premiums are increasing over time, and it is one of the clearest signals of business momentum. For FP&A, premium growth helps us understand whether we are gaining market share or how strong our new business pipeline really is. In short, it tells us how fast and how well the insurance company is expanding. That brings us to our insurance industry KPI number 5, which is the retention rate, also sometimes known as the policy renewal rate. This metric tracks how many policies are renewed at the end of their term. The formula is straightforward. Retention percentage equals renewed policies divided by the policies eligible for renewal. For FP&A, renewals are typically far more profitable than acquiring new business. So higher retention directly boosts customer lifetime value and the overall profitability. Next on our list is the insurance industry KPI number 6, which is called as the claims frequency. Claims frequency measures how often claims are made within our insurance portfolio. Now, frequency is calculated by taking the number of claims received divided by the total number of policies. For FP, this is important because it gives us an early signal of pricing adequacy and the overall risk quality of our book. If frequency starts to rise, it can indicate a shift in the customer behavior, risk mix, or market conditions that we need to respond to quickly. The next one is the insurance industry KPI number 7, called as the claims severity. This metric tells us the average cost of each insurance claim. It is calculated by taking the total claim cost, dividing it by the total number of claims. For FP&A, even if the claim frequency stays stable, a rising severity can quickly erode profitability. It is a key indicator of inflation, repair cost trends, and the overall claim complexity. This brings us to the insurance industry KPI number 8, which is the solvency ratio. Now, the solvency ratio measures the insurance company's ability to meet long term obligations. Essentially, it tells how financially strong the insurance company is. It is equal to the available capital divided by the required capital. For FP&A, this isn't just a performance metric, it is a regulatory requirement. A low solvency ratio can trigger the need for additional capital or even a redesign of the portfolio to reduce risk. Next on the list is the insurance industry KPI number 9, known as the embedded value growth. This is a metric that's especially important in the life insurance business. The embedded value represents the present value of the future profits plus the adjusted net worth of the business. For FP&A, this is important because the embedded value growth shows the long term profitability of the portfolio, not just what we earned this year, but the value that we are building for the future. Insurance industry KPI number 10 is the new business margin, also known as the NBM. The new business margin measures the profitability of the newly sold policies. New business margin is calculated by taking the new business profit, dividing it by the present value of the new business premium. For FP&A, the new business margin helps evaluate whether the new products, segments, or distribution channels are truly worth scaling and which ones may need an adjustment. KPI number 11 is the combined operating ratio, also known as the COR, a metric commonly used in European countries. It is similar to the combined ratio, but it goes a step further by incorporating additional operating metrics for a more complete view of the performance. For FP&A, the COR provides a deeper assessment of the sustainability of our underwriting results, helping us understand whether the business can consistently operate as a profit. Next is the KPI number 12, which is called as the CAC or the customer acquisition cost. The CAC tracks how much it costs to acquire a single policy holder, whether through agents, brokers, digital marketing, or partnerships. CAC equals the total acquisition cost divided by the total number of new policies sold. For FP&A, when the CAC rises, the profitability drops and it takes longer for a customer's lifetime value to break even. It is one of the most important indicators of insurance companies' growth efficiency. Next is the insurance industry KPI number 13, known as the policy lapse or the surrender rate. The policy lapse metric shows how many policies are discontinued before reaching maturity. Lapse rate equals the lapse policies divided by the total active policies. For FP&A, a high lapse rate can signal issues like poor product market fit or low customer satisfaction, which can impact long term profitability and retention strategies. Next comes the investment yield. This measures the returns earned on the premiums that we have invested. Investment yield is equal to the investment income divided by the investment assets. For FP&A, even a small change in the investment yield can have big impact on the total profitability because insurance companies typically manage massive pools of assets. It is a key driver of the overall financial performance of the insurance company. And finally, we talk about the final KPI number 15, which is the NPS or the Net Promoter Score. This metric shows how likely customers are to recommend our insurance product to others. NPS equals the percentage of promoters minus the percentage of detractors. For FP&A, NPA is one of the strongest predictors of policy renewals, upsell potential, and long term revenue growth. High scores signal satisfied customers and a healthier and more sustainable insurance business. So these insurance KPIs helps FP&A leaders understand underwriting quality, cost efficiency, customer loyalty, and the long-term financial strength of the insurance company. FP&A combines these numbers to answer big questions like: Are we pricing risk correctly? Are claims trending in a dangerous direction? Is our insurance portfolio profitable? Can we sustain long term insurance claim payouts? Are the customers going to stay with us? Let us do a quick recap of all the KPIs that we have covered so far. We started with understanding the underwriting health of the company by looking at KPIs like the loss ratio, claims severity, claims frequency, and the combined ratio. Next, we talked about the customer health, the retention rate, policy lapse rate, NPS, and the customer acquisition cost. We also talked about the financial strength, the solvency ratio, embedded value growth, and the investment yield. Finally, we looked at the growth and the competitive metrics, including the premium growth, new business margin, and the combined operating ratio. By tracking these KPIs consistently, you can ensure that your insurance company remains stable, profitable, and ready for the future. Why do some power companies deliver reliable electricity, high efficiency, and strong financial results, while others face outages, cost overruns, and penalties? The difference is very simple. They track the right KPIs. And in this video, I will break down the top 15 power and utilities KPI that every FP&A and operations leader must know. Before we jump into the KPIs, let us first quickly understand how this industry operates because each of the KPI maps directly into a stage into the electricity value chain. The power and utility company usually operate across these three core functions. The first one is the electricity generation. This is where the electricity is produced. It could be thermal electricity, hydro, solar, wind, or nuclear. KPIs like the PLF, heat rate, forced outage rate, and cost per are important here. The second stage is the transmission stage. This is where the electricity travels across long high voltage lines to various substations. KPIs like the transmission loss, grid availability, and SAIDI or SAFE come from here. The third and the final stage is the distribution of electricity. This is where the electricity is delivered to the end consumers at usable voltages. KPIs like the AT&C loss, billing efficiency, outage hours, and customer complaints belong here. This industry has extremely thin margins, high regulatory pressure, and massive capital requirements. So KPIs matter more here than in almost any other industry. Now that we understand how the power sector works, let us dive into the KPIs. Starting with the heartbeat of every power plant, which is the plant load factor, also known as the PLF. The PLF or the plant load factor measures how effectively a plant's capacity is being utilized. The formula is taking the actual generation number of units, dividing it by the maximum possible number of units generation. For FP&A, a high PLF reduces the cost per kWh and improves profitability. The power and utilities KPI number two is known as the heat rate or the efficiency. The heat rate or the efficiency indicates how efficiently the fuel is converted into electricity. It is calculated by taking the fuel energy input and dividing it by the electrical output. For FP&A, a lower heat rate is equal to higher efficiency and lower fuel cost. That is the biggest cost driver in the thermal plants. KPI number three is the forced outage rate, also known as the FOR. The forced outage rate tracks unplanned shutdowns. It is calculated by taking the forced outage hours and dividing it by the total operating hours. For FP&A, the unplanned outages reduce revenue and increases maintenance cost. That brings us to our power and utilities KPI number 4, which is known as the cost per kWh generated. It measures how much it costs to produce each unit of electricity. It is calculated by taking the total generation cost, dividing it by the number of units generated. For FP&A, core profitability KPI is this one, which is used to negotiate terms and PPAs. Next on our list is the KPI number 5, which is the renewable versus the non renewable mix. This shows progress towards sustainability and long term energy transition goals. For FP&A, this impacts capex planning, carbon compliance, and investor perception. We have already covered the top 5 electricity generation KPIs. Now, let us move to the electricity transmission KPIs. Power and utilities KPI number 6 is the transmission loss percentage. This measures electricity loss during high voltage transfer. It is calculated by taking the energy sent, subtracting the energy received, dividing it by the energy sent. For FP&A, lower losses improve efficiency and meets regulatory requirement. Next on our list is the KPI number 7, which is related to system reliability, also called as the SAIDI and SAFE. Here, the system reliability is measured using SAIDI, which is how long the outages last, and SAFE, how often the outages occur, making them the gold standard KPIs for the grid performance. For FP&A, weak scores here translate into regulatory penalties, lost customer trust, and forced capex to fix aging infrastructure. Next comes KPI number 8, which is grid availability, which measures the percentage of time transmission assets are up and running. It is calculated by taking the uptime divided by the total time. For FP&A, higher availability means fewer bottlenecks, smoother energy flow, and better asset utilization without congestion related costs. Next is KPI number 9, which is the transmission line utilization, which shows how much of the line's rated capacity is actually being used in real operations. For FP&A, it helps balance risk and efficiency, avoiding costly overloads while signaling when grid expansion capex is truly justified. Power and utility KPI number 10 is the capex to asset base ratio. It shows investment in grid modernization relative to its current assets. It's calculated by taking the capex number and dividing it by the total asset base. For FP&A, a higher capex ratio signals future growth. Too low indicates aging infrastructure. After looking at the electricity generation and transmission KPIs, the next set of KPIs are related to electricity distribution. Let us take a look at it one by one. KPI number 11 is the AT&C losses. AT&C losses capture both technical losses and commercial leakages, making them the single most critical KPI for distribution utilities. For FP&A, even a small reduction here has an outsized impact on profitability and cash flow, often delivering returns faster than the new capacity investment. Next up is our KPI number 12, which is the distribution loss percentage. Distribution loss percentage measures pure technical losses in the low voltage network by comparing energy input with the energy actually sold. For FP&A, it pinpoints weaker feeders and overloaded transformers, guiding targeted maintenance and capex instead of blanket upgrades. Coming to our KPI number 13, which is billing efficiency, also known as collection efficiency. This tracks how much billed energy is actually being collected. Collection efficiency is calculated by taking the amount collected divided by the amount billed. For FP&A, this directly drives cash flow, working capital, and liquidity. Next one on the list is KPI number 14, which is the customer outage hours, which measures the total outage hours experienced by the customers. For FP&A, high outage hours results in lower satisfaction and increased regulatory scrutiny. That brings us to our final KPI on this list, which is the customer complaints per 1,000 users. This shows the volume of complaints received. It is calculated by taking the number of complaints, dividing it by the total customers into 1,000. For FP&A, a strong indicator of success quality, system reliability, and consumer trust. These 15 KPIs cover the entire electricity value chain from generation efficiency to transmission reliability to distribution performance and also customer satisfaction. FP&A team uses these metrics to answer very crucial questions like, are the plants running efficiently? Is the grid reliable? Are losses under control? Are customers satisfied? Do we have enough capex for modernization? All right, let's do a quick recap. We first talked about electricity generation related KPIs, which included the PLF, heat rate, forced outages, cost per kWh, and renewable non renewable mix. Next, we move on to electricity transmission KPIs like loss percentage, SAIDI and SAFE, availability, utilization, and capex ratio. And finally, we moved on to the distribution KPIs, which included the AT&C losses, billing efficiency, outage hours, and complaints. If you track these KPIs consistently, your electricity and utilities company becomes more efficient, reliable, and financially sustainable. Why do some telecom companies scale profitability and dominate the 5G space, while others struggle with churn and shrinking margins? The difference could be the visibility into the right key performance indicators. In this video, we will break down the top 15 telecom industry KPIs that every FP&A strategy and product leader must know. So before we dive into the telecom KPIs, let us first quickly understand how the telecom industry operates end to end. Because every KPI maps back onto one of these pillars. Telecom companies usually operate across these five major functions. The first part is the network infrastructure and capacity, which includes building towers, fiber lines, spectrum, and 5G networks. KPIs like uptime, capex ratios, 5G coverage, and cost per GB comes from here. The second part is the customer acquisition and activation. This includes some marketing, SIM card activations, KYC onboarding, and retailer incentives. KPIs like CAC or the customer acquisition cost, net ads, and ARPU come from here. The third part is the usage and monetization. Voice minutes, data consumption, enterprise solutions, all drives revenues. KPIs like the average revenue per user, revenue mix, and EBITDA margins comes from here. The fourth part is the customer experience and retention, network quality, call drops, complaint resolution, and service reliability. This drives KPIs like net promoter score, churn, and call drop rate. And finally, the fifth part is the enterprise and corporate solutions. a fast growing, high margin segment, cloud, IoT, cybersecurity, managed services. KPIs like the enterprise revenue growth come from here. Now, telecom KPIs matter because they connect infrastructure decisions with the customer behavior and long term profitability. Okay, now that we understand how a telecom operator works, let us dive into the KPIs that truly determine the telecom company's success. Starting with the king of monetization, average revenue per user, or also known as ARPU. Average revenue per user measures how much revenue each active subscriber generates. ARPU is calculated by taking the total revenues and dividing it by the total subscribers. For FP&A, a higher average revenue per user means better segmentation, pricing, and customer loyalty, which is very critical for long term profitability. Telecom KPI number two is the churn rate. The churn rate measures how many subscribers leave your network. The churn rate is calculated by taking the subscribers lost, dividing it by the subscribers at the beginning of the period. For FP&A, even a 1% raise in the churn can destroy millions in ARR, which is the single biggest threat to telecom companies' revenue. Next on our list is the telecom KPI number three, which is the subscriber growth rate, also known as the net adds. Net adds measures how fast your subscriber base is growing. Net adds is calculated by subtracting the lost subscribers from the new subscribers. From FP&A point of view, the net adds signal brand competitiveness and marketing momentum, which is a key investor metric. Next up is KPI number four, which is the data consumption per user. This tracks how much mobile data each subscriber uses. For FP&A, higher usage boosts average revenue per user but also increases network load. FP&A uses this for capacity planning and 5G ROI. For KPI number five, we have the revenue mix, which is the mix between the data, voice, and enterprise segments, which shows how revenue is distributed across all of these three segments. For FP&A, growth in enterprise and data improves margins. Declining voice revenues also highlights digital transition risk. Next is the telecom KPI number six, which is the EBITDA margin, the gold standard for telecom profitability. It is calculated by taking the EBITDA and dividing it by the total revenues. For FP&A, EBITDA margin determines the financial health, debt capacity, and pricing flexibility. Next up is telecom KPI number seven, which is the network availability, also known as the uptime percentage. The uptime percentage measures how often the network is operational. It is calculated by taking the available time divided by the total time. For FP&A, downtime increases churn and regulatory penalties. Uptime is directly tied to customer experience. On a quick side note, if you are serious about growing your career in FP&A, then do check out our Certified Global FP&A Professional Program. CGFPA is a 6-month accredited certification in FP&A designed to help you become real business partners. If that sounds something you would be interested in, links are in the description. Also, there are a bunch of free resources that you can download on FP&A, including books and free courses. You will find all the links in the description. Moving on to KPI number 8 for telecom industry is the 5G coverage percentage. This measures how much of the population or geography is covered by the 5G network. Tracking 5G rollout helps justify capex, model future revenues, and assess competitive pricing. Next, we have is the telecom KPI number 9, which is capex to sales ratio. This shows how much of your revenues are reinvested back into the network and infrastructure. Capex to sales is calculated by taking the capex cost and dividing it by the total revenues. If the capex to sales ratio is too high, that means you might be burning cash. On the other hand, if it is too low, then it might also mean that you could be falling behind on network quality. Next is telecom KPI number 10, which is customer lifetime value, also known as CLTV. The CLTV measures the long term revenues from each subscriber. CLTV is calculated by multiplying the average revenue per user with the average customer lifespan. For FP&A teams, FPA comparison to CAC tells us whether the acquisition strategies of the telecom company are sustainable or not. Next, let us talk about one of the most important mobile services these days, which is the data. KPI number 11 is the cost per GB delivered, which tracks the operational cost of delivering 1 gigabyte of data. It is a core metric for especially the 4G and the 5G era telecom companies. Lowering the cost per gigabyte usually boosts margin without raising prices. Next on telecom KPI number 12 is the customer acquisition cost, also known as the CAC. The CAC shows how expensive it is to acquire one new subscriber. CAC is calculated by taking the total actual spends, dividing it by the new subscribers. CAC rising faster than average revenue per user destroys margin, which is a common risk in competitive markets for telecom industry. After looking at the data services, let us now come to the calling service. This brings us to our KPI number 13, which is the average call drop rate. This measures how often the calls get disconnected due to poor network or network failure. Call drop rate is calculated by taking the number of dropped calls and dividing it by the total attempted calls. It is one of the biggest drivers of net promoter score and churn, and regulators usually track this very closely. On number 14, we have the enterprise or the corporate revenue growth. This tracks the growth in the B2B services like cloud, IoT, cybersecurity, and lease lines. Enterprise is a high margin segment and very crucial for diversifying away from low margin consumer markets. Finally, we come to the telecom KPI number 15, which is the net promoter score, also known as the NPS. The NPS measures the customer satisfaction and likelihood for the customers to recommend us. It is calculated by subtracting the percentage of detractors from the percentage of promoters. This is one of the most reliable predictor of churn. Improving NPS usually helps in lifting long-term revenues. So we've looked at the different types of telecom KPIs, including KPIs related to network quality, customer behavior, financial strength, and competitive positioning. FP&A teams bring all of these numbers together to answer questions like: are we growing the business profitably? Is the network strong enough to handle 5G demand? Are churn and CAC under control? Or which segments will drive the future revenue growth for the company? Let us do a quick recap. We started by discussing the revenue and profitability KPIs like the average revenue per user, EBITDA margin, and revenue mix. Then we moved on to some network performance KPIs like the uptime, call drop rate, and 5G coverage percentage. We also talked about the efficiency and cost KPIs like the cost per gigabyte and capex to sales. Finally, we discussed the growth metrics like net adds and enterprise revenue growth. If you track these KPIs consistently, you will build a telecom business that's competitive, scalable, and profitable. If you enjoyed this breakdown of the top 15 telecom company KPIs, do like this video and subscribe to our FP&A channel for more such FP&A videos. Also, don't forget to check out a bunch of free resources like books, courses, and cheat sheets related to FP&A. All the links are in the description below. Hi, why do you think some IT companies scale into multi-million dollar powerhouses with high margins and sticky clients, while the others struggle with delivery issues, talent churn, and weak pipelines? The answer lies in tracking the right key performance indicators, the numbers that connect finance, delivery, HR, and sales execution. So in today's videos, we will break down the top 20 KPIs that every IT software services leader must master. But before we jump into the KPIs, let us first quickly understand the operating engine of an IT services or a software company. There are four core functions. First is finance and monetization. This includes revenue growth, profitability, collections, and revenue mix across digital versus legacy services. The second is the delivery and operations. This is the heart of the IT services: utilization, billing rates, defects, project profitability, and on time delivery. The third core function is the HR and workforce management. Talent is the product in IT companies. So, hiring speed, attrition, training, and bench strength decides the delivery success. And finally, you have the sales and the client management. Deal wins, renewals, pipeline, and client concentration determine the future revenue and growth. Because IT companies rely on people, projects, and long term client relationships, The KPIs ensure that the execution aligns with the financial outcomes. Now that we understand the operating model of IT companies, let us quickly dive into the KPIs, starting with the ones every CFO tracks, the finance KPIs. KPI number one is the revenue growth percentage. It is calculated by taking the current period revenue minus the previous period revenue divided by the previous period revenue. It tells you whether the business is actually moving forward across clients and service lines by comparing the current revenue to the last period. For FP&A teams, this is critical because it signals market competitiveness and how much growth runway the business truly has. Next on the list is the IT KPI number two, the operating margin, also known as the EBIT margin. Operating margin is calculated by taking the operating profit and dividing it by the revenues. It is one of the most closely watched profitability metric in the IT services, showing how much profit you generate from every rupee of the revenue. For FP&A, this directly impacts cash flow, valuation, and how much the business can reinvest for future growth. IT KPI number three is the revenue per employee. Revenue per employee is calculated by taking the total revenue and dividing it by the number of total employees. It measures how productive the workforce really is by showing how much revenue each employee generates. For FP&A, a higher number year signals stronger pricing power and more efficient delivery models. IT KPI number four is the days sales outstanding or the DSO. The DSO is calculated by taking the accounts receivable, dividing it by the total credit sales multiplied by the number of days. It shows how quickly the business converts revenue into actual cash. For FP&A, a lower DSO means better working capital health and lower financing costs. Next on our list is the KPI number five, which is the digital revenue percentage of the total revenues. It tells you how much of your revenues comes from modern high margin services like cloud, AI, cybersecurity, and analytics. For FP&A, a higher digital mix directly lifts the margin and strengthens the long term competitiveness. All these finance KPIs shows how healthy the business looks on paper, but delivery KPIs show how well the engine actually runs. IT KPI number six is the utilization rate. This is the single biggest driver of IT services margin. It is calculated by taking the billable hours and dividing it by the total available hours. For FP&A, even a 2% drop in utilization can wipe out millions in EBIT. The next is KPI number seven, which is the billing or the realization rate. It is calculated by taking the actual billing divided by the standard billing rate. It shows how much of your potential billing you actually convert into revenue versus the standard rates. For FP&A, this is a direct signal of pricing power and whether the contracts are truly profitable. That brings us to KPI number eight, which is the on time delivery percentage. It measures how consistently projects are delivered as promised. For FP&A, this directly drives client satisfaction, renewals, and future upsell opportunities. IT KPI number nine is the project margin, also called the delivery margin. The project margin is calculated by taking the project revenues minus the project cost divided by the project revenues. It reveals the true profitability of work at the project level and not just at the company level. For FP&A, this is critical because when project margins slip, overall company margins collapse fast. Next is IT KPI number 10, the defect density, also known as the rework percentage. The defect density measures the quality of what the teams actually deliver. For FP&A, a high rework rate quietly destroys margins by increasing costs, delaying timelines, and damaging the client trust. The delivery KPIs are the engine, but the engine only works when the people are strong. That's where our HR KPIs come in, which are the next set of KPIs. ID KPI number 11 is the employee attrition rate. The attrition percentage is calculated by taking the number of employees leaving, dividing it by the average number of employees. This is one of the most critical HR metric in the IT services, showing how many people leave over a period of time. For FP&A, a high attrition drives up the hiring costs and slows delivery, directly hurting margins and growth. IT KPI number 12 is the training hours per employee. This shows how seriously the company is investing in upskilling for cloud, AI, automation, and cybersecurity. For FP&A, a higher training typically leads to better delivery quality and lower rework cost. IT KPI number 13 is the bench strength percentage. It is calculated by taking the number of employees on the bench, dividing it by the total number of employees. The bench percentage strength shows how many employees are available but not currently billable. For FP&A, a bench that is too high means wasted cost, while if it is too low, that means the business can't scale fast when the demand hits. KPI number 14 is the employee satisfaction, often measured through ENPS or Employee Net Promoter Score. It reflects the morale and the workplace culture across the organization. For FP&A, a strong ENPS score is a leading indicator of lower attrition and higher productivity. KPI number 15 is the average hiring lead time. The lead time is calculated by taking the days from the job opening to the offer acceptance. It measures how quickly the organization can fill critical talent gaps from job opening to offer acceptance. For FP&A, slow hiring directly delays project kickoffs and pushes the revenue out. After looking at the HR KPIs, now let us move to the final piece of the IT services engine, which is the sales KPIs. Because without the deal flow, no IT company can scale. KPI number 16 is the deal wins, measured through the total contract value TCV and the average contract value ACV. It tracks the total and the average value of the contracts the business is closing. For FP&A, this is the strongest forward looking signal of the future revenues. Next up is IT KPI number 17, which is the win rate percentage. Now, the win rate is calculated by taking the number of deals won, dividing it by the total number of deals submitted. It shows how competitive the company is when bidding for RFPs and tenders. For FP&A, a low win rate is an early warning sign of pricing pressure or weak differentiation in the market. ID KPI number 18 is the client retention rate. The retention percentage is calculated by taking the number of clients retained, dividing it by the total number of clients. It measures how many clients stay, renew, and expand their contracts over the period of time. For FP&A, this matters because existing clients guarantee the majority of the revenue and profit in IIT services. KPI number 19 for IT services companies is the top 10 client revenue share. It highlights how dependent the business is on a small set of customers. For FP&A, the top 10 clients contribute more than 50 to 60% of revenue, then the concentration risk becomes dangerously high. Finally, that brings us to our KPI number 20, which is the pipeline value or also known as the coverage ratio. The coverage ratio is calculated by taking the pipeline value and dividing it by the sales target. It shows how strong the future deal flow is compared to the sales targets. For FP&A, this is crucial because it helps predict upcoming growth and plan hiring and capacity well in advance. These 20 IT services company KPIs connect finance, delivery, workforce, and sales, the four engines of an IT services company. The FP&A teams use these metrics to answer critical questions like: are we growing profitably? Are delivery margins stable? Is our talent bench ready for the future projects? Is the pipeline strong enough to sustain growth? Let us do a quick recap of the four buckets. First, we talked about the finance KPIs like the growth, margins, collection, and the digital revenue mix. Next, we moved on to the delivery KPIs like the utilization, billing, quality, and the project margins. We also talked about the HR related KPIs, the attrition, training, hiring speed, and the bench strength. Finally, we talked about the sales related KPIs like the deals, the win rates, the retention, and the pipeline. If the company tracks these KPIs consistently, the IT company becomes scalable, predictable, and highly profitable. If you enjoyed this breakdown of the top 20 IT company KPIs, then do like the video and also subscribe to our channel for more such FP&A video content. Agriculture is not just farming anymore. It is a full business model with very thin margins, high risk, and zero room for guesswork. Today, I'm going to break down the top 15 agriculture industry KPIs that every agri-business leader and FP&A professional must master to run an agriculture business and make it scalable and profitable. But before we dive into the KPIs, let us first quickly understand how the entire agriculture ecosystem works end to end. Because each of the KPIs that we will be discussing will map to a specific stage. Agriculture run across these three major pillars. The first one is farming and crop production. This includes soil preparation, seeds, irrigation, fertilizers, pest control, and harvesting. KPIs like yield per hectare, water efficiency, input costs, and pest incidents come from here. The second pillar is the supply chain and logistics, post harvest handling, cold storage, transportation, and inventory management. KPIs like the post harvest loss, cold chain utilization, transportation costs, and inventory turnover originate here. And the third pillar is the processing and agribusiness, milling, packing, grading, refining, dairy processing, oil extraction, and more. KPIs like processing yield, COGP, quality rejection rate, and market price realization are from here. And because the agricultural business depends so much on natural cycles, weather, perishability, and thin margins, KPIs become a powerful early warning system for managing risk and profitability. Now that we understand the agriculture value chain, let us jump into the KPIs. Starting with the single most important metric of farm performance, the crop yield per hectare. The crop yield per hectare is calculated by taking the total output and dividing it by the total land area. It shows how efficiently land is converted into actual output, making it the most fundamental productivity metric in agriculture. For FP&A, higher yields directly reduce the cost per unit and significantly improve the overall farm profitability. Agribusiness KPI number two is the input cost per acre. Now, the input cost per acre is calculated by taking the total input cost and dividing it by the land acres. It tracks how much you are spending on seeds, fertilizer, labor, irrigation, and pesticides for each unit of land. For FP&A, this metric is important for cost control and for judging the return on investment of different farming practices. Next on our list is the agribusiness KPI number three, water usage efficiency. Now, the water usage efficiency is calculated by taking the yield and dividing it by the quantity of the water used. It shows how effectively the water is converted into crop output, not just how much water is consumed. For FP&A, this is critical for sustainability, cost control, and protecting the long term soil and farm viability. KPI number four is the Soil Health Index, which captures the nutrient levels, the pH balance, organic matter, and microbial activity in the soil. For FP&A, this acts as a leading indicator of the future yields and guides smarter fertilizer and input investment decisions. That brings us to our agribusiness KPI number five, which is the pest and disease incidence rate. Now, the incidence rate is calculated by taking the affected area, dividing it by the total area. It shows how much of the crop area is affected by pests or disease. For FP&A, this helps forecast potential yield losses, treatment costs, and overall risk to profitability. Now, these farming KPIs shows how well the crops grow, but the real battle begins after harvest. So, next, let us move to the supply chain KPIs. Agribusiness KPI number six is the post harvest loss percentage. Now, the loss percentage is calculated by taking the total quantity lost and dividing it by the total quantity harvested. It measures how much produce is lost during handling, transport, and storage after harvest. For FP&A, even small losses here quietly erode the farmer income and processor's margin. The agri-business KPI number seven is the cold chain utilization percentage. Now, this utilization percentage is calculated by taking the use capacity and dividing it by the total capacity. It shows how effectively cold storage capacity is being used across the supply chain. For FP&A, higher utilization directly reduces spoilage and extends the producer's life, improving both revenue realization and margins. Next on our list is the agribusiness KPI number 8, which is on time delivery rate. Now, the on time delivery percentage is calculated by taking the number of on time deliveries, dividing it by the total number of deliveries. It tracks how reliably perishable goods reach customers as scheduled. For FP&A, a strong on time performance reduces spoilage, improves customer satisfaction, and safeguards revenue. Agribusiness KPI number 9 is the transportation cost per ton. Now, the cost per ton transportation is calculated by taking the total transportation expenses, dividing it by the total number of tons moved. It shows how much it costs to move the produce from the farm to markets or processing facilities. For FP&A, this is a major profitability lever, especially in bulk and low margin crops where logistics cost can make or break the returns. KPI number 10 is the inventory turnover in number of days, which is calculated by taking the average inventory, dividing it by the cost of goods sold, and multiplying it by the number of days. It shows how quickly the harvested produce is sold or processed. For FP&A, slower turnover increases the storage cost and spoilage risk, directly hurting margins. After looking at the supply chain KPIs, next let us move to the final stage, which is processing and agribusiness, where the raw crops turn into finished food products. Agribusiness KPI number 11 is the processing yield percentage. Now, the processing yield is calculated by taking the usable output and dividing it by the raw input. It shows how much usable product you get from raw material and agricultural inputs. For FP&A, the higher processing yields directly reduce cost per unit and expand margins across the value chain. Next on the list is the agri-business KPI number 12, which is also known as the cost of goods processed or COGP. The cost of goods processed tracks the cost of converting raw agricultural inputs into finished or semi-processed products. For FP&A, this is a core profitability metric for mills, dairy plants, sugar factories, and food processing businesses. That brings us to our agri-business KPI number 13, which is the quality rejection rate. Now, the rejection percentage is calculated by taking the number of rejected units, dividing it by the total output. It measures how much output is rejected due to quality issues during processing or grading. For FP&A, high rejection directly increases waste, reprocessing costs, and long-term brand risk. KPI number 14 is the energy consumption per unit of output. Energy per unit is calculated by taking the total energy used, dividing it by the number of units produced. It shows how much energy is used to produce each unit of output in agri processing. For FP&A, this is a key lever for both cost reduction and long term sustainability. And finally, we come to our agribusiness KPI number 15, which is the market price realization percentage. The realization percentage is calculated by taking the actual price, dividing it by the market price. It shows how close your actual selling price is to the prevailing market benchmarks. For FP&A, this reveals true pricing power and how effective the business is at negotiating and timing its sales. These 15 agribusiness KPIs gives you a complete picture of the entire agriculture value chain from soil to the shelf. FP&A teams combine them to answer questions like: Are our farms productive? Are supply chain losses under control? Are we processing efficiently? Or are we capturing maximum market value? Let us do a quick recap. We started with talking about the farming KPIs like the yield, input cost, water efficiency, soil health, and pest incidence. Then we moved on to the supply chain KPIs like the loss percentage, cold chain utilization, delivery, transport cost, turnover, and finally we talked about the processing KPIs like the yield percentage, the cost of goods produced, the rejection rate, the energy usage, and the price realization. If you track these KPIs consistently, your agriculture business will become more productive, efficient, and far more profitable. Why do some airlines operate on razor thin margins yet stay consistently profitable, while majority of the airlines struggle with delays, high costs, and unhappy passengers? One of the reasons is tracking the right key performance indicators, which are the numbers that connect operations, finance, customer experience, and fleet efficiency. Today, we are going to break down the top 15 airline KPIs that every aviation operator, revenue manager, and FP&A leader must master. And before we jump into the airline KPIs, first let us quickly understand the entire airline value chain, because these KPIs map directly to each stage of airline operations. Airline operates across three major pillars. The first pillar is the flight operations and network planning. This covers schedules, aircraft rotations, crew assignments, delays, and fuel usage. KPIs here are the on time performance, load factor, available seat kilometers, revenue passenger kilometers, and fuel efficiency. The second pillar is the financial and revenue management. Airlines typically use dynamic pricing, revenue optimization, ancillary monetization, and cost control to drive profitability. KPIs like the cost per available seat kilometer, revenue per available seat kilometer, yield, EBITDA margin, and ancillary revenue percentage belong here. And finally, the third pillar is the customer experience and ground operations. This includes check in, baggage handling, boarding, cabin experience, and dispute resolution. KPIs like the NPS, complaint rate, service quality, and mishandling rate originate here. Airline business is capital intensive, hyper competitive, and extremely sensitive to fuel prices, which makes KPIs tracking a mission critical. Now that we understand the airline business model, let us begin with the KPIs that define operational excellence, starting with the on time performance. The airline business KPI number one is the on time performance. The on time performance is calculated by taking the number of on time flights divided by the total number of flights. It shows how reliably flights depart or arrive as per schedule. For FP&A, delays quietly dry up crew costs, airport charges, compensation payouts, and erode customer trust at the same time. On a quick side note, if you are serious about growing your career in FP&A, then do check out our Certified Global FP&A Professional Program. CGFPA is a 6-month accredited certification in FP&A designed to help you become real business partners. If that sounds something you would be interested in, links are in the description. Also, there are a bunch of free resources that you can download on FP&A, including books and free courses. You will find all the links in the description. Airline industry KPI number two is the load factor. Now, load factor is calculated by taking the revenue passenger kilometers and dividing it by the available seat kilometers. We will talk about each of this in detail in a few minutes. For now, let us understand that the load factor tells you how full the aircraft actually is on each flight. For FP&A, a higher load factor means more revenue per flight and a lower cost per passenger, directly improving profitability. Connected to that is the airline KPI number 3, ASK. Now, ASK stands for Available Seat Kilometers. It is calculated as the number of seats available multiplied by the distance flown, and it represents the total passenger capacity an airline puts into the market. For FP&A, ASK is critical for planning capacity, evaluating route profitability, and optimizing fleet deployment. Which brings us to our KPI number 4, which is the revenue passenger kilometers, also known as RPK. Now, RPK is calculated by taking the paying passengers and multiplying it by the distance flown. It shows the actual passenger demand by measuring how far passengers are flown. For FP&A, comparing the RPK with ASK reveals the true capacity utilization and the underlying demand trends. The airline industry KPI number 5 is the fuel burn per flight or fuel efficiency. It tracks how much fuel is consumed on each flight. For FP&A, fuel is the single largest cost for any airline. So even a 1% efficiency improvement can save millions of dollars here. So these operational KPIs that we looked at tell us how efficiently we fly. Next, let us look at how profitably we fly with the financial KPIs. Airline KPI number 6 is the cost per available seat kilometer, also known as CASK. The most important cost metric in the airline industry, showing how much it costs to fly one seat for 1 kilometer. For FP&A, lowering CASK directly improves competitiveness and long-term profitability. Now, connected to CASK is our airline KPI number 7, which is revenue per available seat kilometers, also known as RASK. RASK is calculated by taking the passenger revenues and divided it by the ASK. It shows how much revenue each unit of capacity actually generates. For FP&A, RASK is the core metric for comparing pricing power across routes, aircraft types, and competing airlines. Next on our list is the airline KPI number 8, which is yield per passenger. Now, yield per passenger measures the average revenue per passenger per kilometer or per mile flown. It is calculated by taking the passenger revenue and dividing it by the RPK. Now, for FP&A, this is a key indicator of pricing strategy and demand strength. Airline KPI number 9 is the EBITDA margin, an industry standard profitability metric that looks at the earnings before interest, tax, depreciation, amortization, and rent. For FP&A, the EBITDA margin is widely used to assess the financial health and compare airlines on a like for like basis globally. Airline industry KPI number 10 is the ancillary revenue percentage of the total revenues. It captures income from baggage fees, meals, seat upgrades, Wi-Fi, and other add-ons. For FP&A, this is especially critical for low-cost carriers because it lifts margin without adding any more capacity. So we looked at the finance KPIs, which told us how profitable the airline is. But the customer decides whether that profitability lasts. So let us move to our final set of airline KPIs which are related to services. Airline KPI number 11 is the customer satisfaction. Often it is measured through Net Promoter Score, also known as NPS. NPS is calculated by taking the percentage of promoters and minusing the percentage of detractors from that. It reflects how loyal the passengers are and most importantly, how likely they are to recommend the airline. For FP&A, a higher NPS fuels repeat bookings and upgrades, making revenues more stable and predictable. Airline industry KPI number 12 is the baggage mishandling rate, which is calculated by taking the total number of incidences of baggage loss, dividing it by the total number of passengers, multiplying it by 1000. It tracks how many bags are lost, delayed, or damaged per 1000 passengers. For FP&A, a higher mishandling directly increases compensation costs and drives negative customer reviews that could hurt future demand. Airline industry KPI number 13 is the complaint rate per 1000 passengers. It shows how often customers raise issues across the operations. For FP&A, this metric helps pinpoint service gaps and operational bottlenecks before they start hurting revenues and brand. KPI number 14 for airline industry is the onboard service quality score, which reflects the passenger experience through food, cleanliness, crew behavior, Wi-Fi, and the overall comfort in the airline. For FP&A, stronger onboarding experience directly supports higher yield and increased ancillary revenues. Finally, that brings us to our final airline KPI number 15, which is the first contact resolution. The first contact resolution measures how often customer issues are resolved in a single interaction without follow ups. For FP&A, the higher first contact resolution reduces service costs and protects loyalty and repeat revenues. These 15 airline industry KPIs give leaders a full cockpit view of the airline performance, operational reliability, network efficiency, profitability, and customer experience. FP&A teams use these KPIs to answer key questions like: are we flying efficiently? Are our routes profitable? Are our customers happy? Is our cost under control? Let us do a quick recap. We started with the operational airline KPIs like the on time performance, load factor, ASK, RPK, and fuel efficiency. Then we moved on to the financial KPIs like the CASK, RASK, yield, EBITDA margin, and ancillary revenue. Then we talked about the customer KPIs, including the Net Promoter Score, mishandling, complaints, onboarding experience. If you track these consistently for your airline, your business will become more efficient, profitable, and most importantly, loved by customers. If you enjoyed watching this breakdown of the top 15 airline industry KPIs, do like the video and subscribe to our FP&A channel for more such FP&A content. Also, let me know in the comment below which other industry KPI you would like me to create a video on. Also, don't forget to check out a bunch of free FP&A resources, including books, cheat sheets, and courses. All the links are in the description below. Thank you so much for watching, and I will see you in the next video.